Hi everyone, I welcome you all to my YouTube channel Harshmeet Study Circle. I hope all of you are doing good. The Government of India recently released this year's Union Budget. Now, while the budget is obviously extremely important, there is one more document that the government comes up with just one day before the budget, that is called the Economic Survey. If you compare the two, budget is mostly about the predictions of how the next year will be about. While economic survey is about what the government has achieved, it is filled with data, numbers, facts, a lot of important graphs from the side of the government itself. So one, it is extremely dense with data, and second, it is very authentic data because it is coming from the government itself, and that is why it is one of the most important documents for your examinations, both for the prelims and the mains examination point of view. This year's economic budget had 13 chapters in total. I am here to start a new series where I will be summarizing for you one by one all the 13 chapters. So I will be taking out the most important information from chapter number 1 in this video. I'll be showing you a few graphs also. This information has been made easy for you to understand. At the end, I'll also have some practice questions for you so that you can know what kind of questions you can expect. But before we dive deep into this year's economic survey and what did it say, for those who don't know, let me first explain what the economic survey is. As I told you, economic survey is an official document released by the Government of India, by the Union Ministry of Finance, and it is released one day before the Union Budget. So while the budget mostly tells about the government's plan of the next year, or the year that will start now from 1st of April, economic survey tells about the condition of the country in the past 1 year, about our imports, export, GDP number, about our growth, the predictions for the growth, all of that is in the economic survey. It talks about global trends as well. So it is released by the Ministry of Finance and it is an indicator about past financial year, and it also talks about the challenges that we are facing. And interestingly, it's not just about economics. For example, in the past, economic surveys have talked about agriculture, they have talked about judiciary, they have talked about how there are many cases pending in the country, how to resolve, the suggestions given. So it's not just about economics, it's about a lot of other things. So this is what economic survey is all about. Now, let me give you a few important things about this before we dive into chapter number 1. So who prepares the economic survey? It is the Department of Economic Affairs under the Ministry of Finance. So Ministry of Finance has multiple departments working under it. One of them is called Department of Economic Affairs. This is the same department, by the way, that prepares the annual budget also. So they prepare the economic survey under the guidance of the Chief Economic Advisor to the Government of India. Chief Economic Advisor, it is his note that is on the first page of the economic survey. So he is a primary author, coordinator. Economic division under Ministry of Finance has many other economists, and the inputs, the data is gathered from multiple resources such as RBI, Niti Aayog, etc. Now, this year's, that is 2025, economic survey that has just been released, it has been under the guidance of V. Anant Nageswar because he is the Chief Economic Advisor to the Government of India right now. So whoever holds this position, ex officio, that is the person under whose leadership this economic survey comes out. And when is it released? As I said, one day before the Union Budget. It is released so that all the numbers are out in the open. Now, if you look at the history of it, it started way back after our independence. So it has been a long-standing tradition. 1950-51 when it first started, but until 1964, it was not released separately. Until 1964, it was actually a part of the Union Budget itself. It was after 1964, since then, that the economic survey has been separated. And there is one separate document, economic survey, and the budget is a separate document altogether. So it has been a tradition since we became a republic, but again, since 1964, it has been a separate document. Before we dive into chapter number 1, again reminding you, I am running the prelims crash course for 2025. It's in the form of a questions marathon. It's on my own app where every alternate day I have a class where I discuss 25 questions. Along with explanations, you get the recorded classes, you get the PDFs for you to revise. It will cover all the subjects till the end, including current affairs as well, to help you revise. If you want to enroll for this, you can download my app. I've given the link of the app in the description of this video. Make sure that if you have any question, you can get in touch with me on WhatsApp as well. I've given my number in the description of the video. Let's see then. The first chapter of this year's economic survey is titled The State of the Economy Getting Back into the Fast Lane. So it talks about what is the state of economy right now, meaning at what rate are we growing, what is the rate of growth around the entire world, what are the challenges that we are facing, the global trends, etc. This is what the topic of the chapter is. So it starts by saying that 2024 has been a turbulent year around the entire world, and it has been the case because of many reasons. There have been multiple conflicts. The Ukraine-Russia war has went on, Israel and Hamas getting into a war again, and there have been multiple such issues of countries confronting with each other, because of which the global trade has been up and down. Whenever you have these situations where two or more big countries are not at good terms with each other, there are sanctions all around, it leads to disruption in the supply chain. For example, Ukraine exports a lot of wheat, sunflower oil, etc. Those prices went up across the entire world because the supply chain was disrupted. Because of this, there have been some disruption around the world. Despite all of this, the economic survey says that India's real GDP is estimated to be 6.4% in financial year 2025. Now, please understand this. It is an expectation estimate that this is what our GDP will be in financial year 2025. And the economic survey says that it is a good number and it will be achieved mainly because of agricultural output and services led expansion. Now, please understand what they mean to say is that we are not expecting a lot from manufacturing. If the three components of economy is agriculture, manufacturing and services, we are mainly expecting growth to come from services and a robust agricultural output, but we are not expecting a lot from manufacturing. So that is not a good sign, because India has been trying to give a push to make in India, to give more jobs to people, because out of all the three, agriculture, services and manufacturing, most of the jobs can be unlocked through manufacturing only, which is where India is lagging. Let's first talk about the global economic scenario. This is what the survey's first chapter talks about. It says that the global trends, if you look at the world economy, in 2023, global economy grew by 3.3%, expected to grow at 3.2% in the current year, 2024. Next year's IMF projections are 3.3. Again, all these are IMF projections that the survey quotes. The survey says that services will be the main growth driver. Economy or around the world, multiple economies, not just India, have struggled to give a push to manufacturing. Now, see, manufacturing is a tricky thing to get right. China has done that, some other countries have done that, but it's very tricky. Manufacturing also is tricky because many countries are now withdrawing from it because it has a negative impact on the environment. Many developed countries, especially, are pushing towards services because it's not that labor intensive. India right now, because we have so many people to give employment to, for us giving a push to manufacturing also is a top priority. The economic survey also says that the global trends still display a bit of uncertainty. Ukraine-Russia war and the other conflicts have led to the trade uncertainties not going away anywhere. What about some areas? There are some regional performances that the survey talks about. It says if you look at the US, their expected rate of growth is 2.8%. Now, please don't compare this by saying, oh, we are growing at 6.5%, US is only 2.8. The base is very different. For us, the base is much lower. It's like saying that, let's say if you earn 100 rupees, let's say your salary is 100 rupees, and there's someone else whose salary is 1 lakh rupees, okay? Now, if this person, the 100 rupee guy, gets an increment of 50%, and this guy gets an increment of even 1%, just see the difference. For him, 50% increment means his salary will be 150. For him, even 1% increment will be his salary will increase by 1000 rupees. So when the base is much larger, you don't need such a big number of growth. So for US, even 2.8% is a pretty good number. In Europe or Eurozone, growth has remained sluggish, means not as expected, about 0.8%, is not even 1%. Germany, that has been the major driver of European growth in the past 2 decades, it is slowing down because of weakness in manufacturing. China also, their manufacturing has been slowing down as per the economic survey. It says that there is low private consumption because there is a downward trend in the population in China also that we are seeing, because of which the private consumption, local people are not buying as much as they used to, and the investments also are slowing down. Similarly, at the global level, there are inflation pressures also that have moderated. The inflation is not as high as it used to be. About the G20 nations, the survey says that the G20 nations have also shown some protectionist measures. Protection measures means a lot of countries are trying to make sure that the other countries don't import a lot of products to them. For example, in India, we have Made in India. We don't want our products or our country to use products imported from China or other countries. So we are giving a push to our own local products, which is called protectionist policy, protectionist measures. So many G20 countries are actually giving a push to these protectionist measures, which has affected about 12.7% of the total G20 trade. Because of this, again, the world where we are proud to say that we are a globalized world, that seems to be decreasing slightly. Many countries are now making strict provisions not to allow other products to enter their countries. US also, with Donald Trump coming back to power and the policy of America first, seems to be going to the path of protectionist policy. This was the global scenario in that screenshot. Let's talk about what India has to offer or what India has done in the year. This is what the economic survey says. So first, the survey says our estimated GDP growth for financial year 25 will be 6.4%, which will again make India the fastest growing major economy in the world. It says that agriculture will be a major driver because of kharif production reaching an all-time high. Services sector will remain strong, IT export, etc. Manufacturing will face difficulty. Now, this is not something new. We are used to manufacturing not giving us the kind of output that we had hoped for. So difficulties in the form of manufacturing will continue to remain. Survey also talks about investment and consumption trends. It says that private consumption, that is the people buying within the country, will remain stable. The good part is the government is investing a lot in capital expenditure. So a lot of money is being spent in infrastructure building, bridges, roads, airports, etc. That is the capex, capital expenditure. It has increased by 8.2% between July and November. Now this is a very good sign. When a country, especially in a developing country, gives a push to capital expenditure, invest a lot of money in building roads, airports, etc. It means, number one, you are building a lot of jobs, and secondly, you're making it easier to do business. So you're giving a push to the economy by spending more money, by creating more jobs as well. This is a trend, a graph to show you that comparison between India and the global GDP growth. As you can see, our GDP growth in India is way above the global average. Please understand, when you say that India is the fastest growing economy in the world, please quote, India is the fastest growing major economy in the world, because there are many small countries with a much smaller base that may have a larger growth, but in terms of major economies, we are the fastest growing. The survey in the first chapter also talks about some macroeconomic stability and fiscal health of the country. For example, it talks about imports and exports. So exports increased by 5.6% in the first half. H1 means first half of the year. So first half basically means from, as you know, India's financial year starts from April. So from 1st April to 6 months. That is from 1st April to the end of, let's say, September. It also says that imports also grew, but slightly at a very small pace, which is a good sign that our exports are growing faster as compared to the imports. Our forex reserves stood at about $630 billion, which is also a good sign, because the more forex reserves you have, the better you are prepared for any uncalled sanctions, or not the sanctions, but any trade disruptions, oil prices increasing in the global market, etc. It also talks about our inflation monetary policy. Food inflation will ease, means the prices will not be as high or increasing as high, because Rabi production will be much better this year. RBI also is focusing on monetary easing. It is making sure that we provide enough capital for the businesses also to expand their business, to expand their ventures. They are making sure that the inflation eases down in India. This is how our GDP has been growing in terms of the three sectors: services, industry, manufacturing and agriculture. The biggest contributor is services, and then it comes from agriculture, then it comes from manufacturing, that is the industry sector. Survey also talks about what are the challenges and the risks that we are facing in our growth. First, external risk, conflicts arising in Middle East, which has always been a part of the world where stability is very far off. In Europe also there are global conflicts that are rising. Now with Donald Trump coming to power, America also doesn't seem to be interested in playing the role of a stabilizer. So it remains to be seen how trade wars, etc. are disrupted. Because as you know, Donald Trump has already announced that I will be increasing tariffs on multiple countries, and countries such as Canada have retaliated as well. So that will lead to some problems in the global market. The trade policy uncertainties will disrupt the supply chain, which might affect our export performance as well. Because see, when a country imposes taxes on your products, you will have to reciprocate, means your products prices will increase. So we have to see how that actually comes up. As I am recording this video, Prime Minister Modi is about to go to America to see how our policy relations or how economic relations between India and US can now go forward. So it remains to be seen how the impact of Donald Trump's policies or Indian policies will result on the ground, or will have a result on the ground or not. These are the external risks. Internally, there is a risk about investment growth, which is dependent on the private sector. See, India for investment has for a long time been dependent on the private sector, private entities putting in their money in manufacturing, putting in their money in investment. It remains to be seen for them whether the market is lucrative enough. That is what the survey says. There is also a risk of inflation, there is also a risk of price fluctuation. Because of climate change, we might have disruption in the agriculture output as well. So it might lead to increase in prices of food as well. Then the first chapter ends by giving some policy recommendations as well to be followed moving forward. It says, number one, we should boost private investment, especially in the field of infrastructure and manufacturing. We should make it lucrative for the private businesses to invest. We should enhance competitiveness. We should have global reforms, structural reforms should be introduced, so that if an outside investor also wants to come in, they have enough confidence in our market. Strengthen the domestic demand, give more money in the hands of the people so that they can buy more products, push our own entrepreneurship, MSMEs, and also have strategic export expansion. Make sure that our export market also expands as much as possible. We can also look into tapping onto the fields of biotechnology, semiconductors, etc. This is what the first chapter of the economic survey says. Now, as promised, I also have a few questions to test yourself from this chapter. First question, which sector contributed the most to India's GDP in financial year 25? Not a difficult one. Agriculture, manufacturing, services and mining. I just told you it is services from where most of our growth has been coming in. Second, which of the following global economic challenges impacted India's trade in 2024? Rising global inflation, geopolitics in Middle East, slowdown in the global manufacturing, or all of the above? Which have been the economic challenges for India? All of them. This is what the economic survey says. All of them have had an impact on our trade in 2024. One more. What is the key structural reform suggested by the economic survey 2025 to enhance India's global competitiveness? Increased trade protectionism. Does it say that we should have trade protectionism? No, opposite. Deregulation, investment in infrastructure. Yes, this is what it says. We just discussed. Investment should be increased. Regulation should be reduced so that we make it lucrative for others to come and invest. More reliance on private sector? No, quite the opposite. Complete ban on foreign investment? No. It is actually the second one which the survey suggests. Here are some questions from the mains examination point of view. This is how the questions can be asked here. If you want, you can try and practice these questions as well. Which brings me to the end of chapter 1 summary. This is chapter number 2 of the summary of this year's economic survey. Yesterday, I put out a video summarizing chapter number 1 of this year's economic survey. As I told you in the last chapter also, there are 13 chapters in total and we'll be summarizing them all because these are extremely crucial for your examination. We have taken out the most important information out of it, and in the end I'll also have some questions for your practice so that you can test yourself. So the second chapter of this year's economic survey has been titled Monetary and Financial Sector Development. So mainly this chapter is divided into two parts. In first part, the economic survey talks about the monetary policy adopted by the RBI this year, the impact of those policies on the banks, on the liquidity in the market, how has it impacted the common people. And in the second part of this chapter, they are talking about the financial sector in India, investments, etc., the profile of the investors, how is it changing, how is it evolving, all these things are mentioned. So these are the two major components of this second chapter. So as I said, let's start with the first one, that is the monetary development. As I said earlier, monetary developments mainly includes the actions of the RBI, monetary policy stand, money supply, etc., and the liquidity situation in the country. So, first highlights. Now, as you know, we have something called the MPC Monetary Policy Committee by the RBI, whose main job is to keep a check on the inflation in the country. Now, the inflation targeting is 4% plus minus 2%, means 2 to 6% is the range that we hope inflation would be in. The RBI's Monetary Policy Committee makes sure that the inflation does not go above 6%, does not go below 2%, because zero inflation also is bad for the economy. How do they do that? They keep on changing repo rate, they keep on changing other measures so that the liquidity, the money supply in the market is controlled. Now, as per the economic survey, for the first 3 quarters, that is for the first 9 months, repo rate by the RBI was kept unchanged at 6.5%. Also, we saw the RBI finally changing its policy from withdrawal of accommodation to neutral. Now, these are important phrases which can be asked in the examination, so you must know this. When you say RBI is following withdrawal of accommodation, what does it mean? What it means is RBI is trying to suck out liquidity from the market. Now, when the RBI suggests, or when the RBI thinks that there is too much inflation, that is, the prices of commodities are increasing, one of the main factors can be that people have too much money in their hand, or money is easily available, so they are buying a lot more stuff, because of which inflation is increasing. So as a result, what they try to do is to control the inflation. They try to bring money out of the market. How? They make it difficult for you to get money. They will make it harder for you to get loan. The loans will cost more. That is called withdrawal of accommodation. So to control inflation, it's a very common thing. In October 2024, finally RBI changed its stand and became neutral. Neutral means not deliberately trying to withdraw money from the market and not pushing money into the market, maintaining a neutral stand altogether. This is called having a neutral approach. So RBI changed its approach from withdrawal of accommodation to neutral in October 2024. Cash reserve ratio was also reduced. Now, as you know, cash reserve ratio means the amount of money that the banks have, which they're supposed to keep in cash, so that it can be used if there is an urgent withdrawal. When the RBI reduces this requirement, for example, RBI said that from 4.5%, now you only have to keep 4% cash with you, means banks now have more money to give out the loans. That means it will increase liquidity in the market. When they increase the cash reserve ratio, when they tell the banks you have to keep more money with you in cash, that means you are withdrawing money or withdrawing liquidity from the market. So cash reserve ratio was reduced, was cut down from 4.5% to 4%, which increased liquidity in the market by about 1.16 lakh crore. That also was an indication that RBI wanted to give more money in the hand of the people. They're not worried about inflation now. About money supply, what changed? So there are important terms that you would know in economics. First, reserve money, which is called M0, it grew by 3.6%. Broad money, which is M3, it also grew by 9.3%. And then money multiplier, MM, which is a good indication of money supply in the market, it also increased to 5.7. So higher money multiplier, higher MM, means that you have more money into the market coming in. Means you have more money in the hand of the people, more liquidity, people are buying more stuff. Apart from that, the banks were encouraged to give more loans. Banks gave more loan to commercial sector, which also increased the money supply in the market. The money multiplier, that is the liquidity, has reached a good level. It had declined during the COVID-19 pandemic, but now it has again reached a good level. So there is more money in the market, which is also done to increase the consumption. When people, the local market consumes more, when they buy more stuff, it gives a push to the industry as well, which are producing that stuff. Those were the monetary policy developments as per the second chapter. Now, economic survey in the second chapter also talks about the financial sector developments of this financial year. Now, what are those developments? First, about the banking sector. For a long time now, banking sector has been facing a lot of flake because of increasing NPAs, non-performing asset. The good part here is gross NPAs have declined. They have in fact reached a 12-year low. They have only now at 2.6% in September 2024, which is a good sign. So net NPA, not performing asset, the money which is not coming back for the banks, declined to 0.6%. Also, the capital to risk weighted asset ratio, that is CRAR, of the scheduled commercial banks also remained at a good level. Means that they have good stability, they do not have a lot of capital in danger, which is always a good sign. Here is a graph from the economic survey which shows you how the gross NPAs have been declining. So in September 2024, they reached at the best point in the last 12 years. Also, CRAR is also well above the required norms as per the Basel norms. So the banking sector seems to be doing pretty well. Bank credit is also increasing, means banks are giving out more loans, so they trust the people more, they trust that the money will come back. So that is also a good sign going forward. About the capital market also, that is the stock market, there's a good sign coming in as per the economic survey. In December 2024, India's stock market outperformed all the emerging countries in the world. Number of IPOs also increased considerably, means a lot more companies became public, opting out to have public money being invested in them, which is a good sign. When a company goes through IPO, means they are opening up their financials for everyone to see, so it brings a lot more transparency. It also brings a lot more investment opportunities for the common people. It also led to financialization of domestic savings, means the domestic savings were not just kept in the bank account, they were invested also, which led to better wealth creation. Insurance pension sector also did well as per the economic survey. India is projected to be the fastest growing insurance market in the G20. Now, there are two factors related to this. One, because of our high population, we always would be a big insurance market. And secondly, because the penetration of insurance is still extremely low. Still, a large population or a large proportion of India's population does not have insurance coverage. So the potential for insurance and the sector to have big numbers is humongous, and that is why we have seen this growth. Financial inclusion also was a big theme in this year's economic survey. They talked about how financial inclusion index has improved, means more and more people are coming into the financial sector. They are now operating their own bank accounts. They are now a part of India's growing economy in the formal sector. Rural financial institutions also played a good role in making sure that the loans are given out to people who are living in far off areas, not just in the urban areas. We also had the Unified Lending Initiative by the RBI, which enhanced the digital lending for MSMEs. So MSMEs, the small, medium enterprises, also were given loans at a much better condition through the banks. Consumer credit also grew, means credit, that is the loans given out to consumers rather than just corporates, that also grew. So banks were giving out more loans to individuals as compared to the businesses, which is also a good sign because it will increase consumption. Rise of non-bank financing, means apart from the banks also, NBFCs, non-banking financial companies, they also gave out many more loans to people for whom banks are not accessible. There is also an increase in unsecured lending, which is slightly worrying. Unsecured lending basically means lending by those companies or those organizations which are outside the purview of regulation of the RBI. So that is a slight concern, because when you're outside the purview of RBI, you are not bound by that. The rates of interest are much higher, and these are unsecured loans. So it is a major cause of concern. Then the economic survey in this chapter talks about some emerging trends and risk in our financial sector. For example, first emerging trend is the rise of young investors. If you look at the number of investors under the age of 30 years, they are about 40% of the entire stock market investors, which is a very good sign. Means people are achieving financial independence at a much younger age. They are investing at a much younger age, and they are not afraid of making these financial decisions for themselves. Equity-based financing also increased. India ranked first globally in the IPO listings. So no country had more IPO listings in the entire world than India in financial year 2024, which again is a big sign. And I told you earlier, large number of companies coming to IPOs means more investment opportunities. Companies are open to scrutiny. They are under regulations of SEBI, so which is always a good sign. Also, there are certain risks involved. For example, when financial markets control many companies, it will lead to systematic risk. For example, when Sensex goes down or when there is a negative news in the global market, it might impact all the companies that are listed. So companies that are listed always would have to face certain danger of shocks from the stock market. Balancing financial growth and stability is also important. So both of these have to be given or have to go hand in hand as per the economic survey. Economic survey in the end of this chapter talks about the financial sector outlook, means what is a prediction in the coming few months. It says financial sector will have a strong growth and will continue the digital transformation. It also says that financial services also would see a lot more innovation coming in, and capital markets, stock exchange, etc. will drive the expansion. There will be many more people who will be investing in these markets in the form of IPOs, etc. This was the main summary, the main pointers from the second chapter of this year's economic survey. Now, to test yourself, I have a few questions. Let's see if you can get them right. First, and see this carefully, consider the following regarding money multiplier. First, an increase in money multiplier indicates improved financial deepening and liquidity in the economy. Is it? Yes, we just discussed that. Higher the value of money multiplier, higher is the liquidity in the market. Money multiplier decrease in financial at 25. No, we just discussed it's the opposite. Money multiplier increase, so there was more liquidity in the Indian financial system. is calculated as a ratio of M0 to M3. No, it's the opposite. It's M3 is to M0. So money multiplier is broad money upon reserve money. So the answer here is A. One only is correct. The second and third statements here are wrong. By the way, I will upload this PDF and PDF of the first chapter as well on my Telegram channel. If you have still not become part of it, I'm giving the link in the description of the video. You can join that as well. Second question, what is the main purpose of RBI's neutral stance in monetary policy? We discussed this. Exclusively target inflation without focusing on growth. To maintain a balance between inflation control and economic growth. To increase money supply or to reduce fiscal deficit. We discussed how RBI has changed its stand from withdrawal of accommodation to neutral. Neutral means now they are trying to balance inflation and economic growth. Rather than focusing on one, they are focusing on both now and trying to balance it out. So the answer here is B. Next, which of the following factors contributed to reduction of gross NPAs of scheduled commercial banks? As we discussed, NPAs have come down to the lowest point of 12 years. What are the factors? Improved credit risk assessment, yes. Higher loan recoveries, yes. Lower fresh slippage, yes. All of the above are the factors because of which we have seen that the NPAs, non-performing assets, are declining, which is a good sign in going forward for the banks. One more question. What does the Financial Inclusion Index measure, FII? Level of financial literacy, not just this. Percentage of population of bank account, not just this. Accessibility, availability, usage of formal financial services. This is what FII measures. As we discussed, FII is improving. It means availability, access, usage of financial services is increasing. It's improving in India. One last question, which of the following is not considered a component of broad money, that is M3? Currency in circulation, demand deposit, time deposit with the banks, or net forex reserve. The answer here is net forex reserve. Tell me in the comment section, what is M0, what is M1, what is M2, what is M3? Tell me the formula for all these, M4 also. Tell me the formula for all these in the comment section. I want to see if you actually know this or not. This brings to the end of this session. I'm reminding you once again, my prelims crash course for 2025 is running on my app. You can download my app from the link in the description and check that course out as well. Let's begin with what chapter number 3 has in store for us. So the third chapter mainly talks about things outside India that have an effect on India. So third chapter is themed external sector getting the FDI right, that is foreign direct investment. As you know, India, the Indian government specifically has been keen on making sure that India is a very attractive proposition for FDI, that is investors who would like to invest in our market. So the government has been doing everything possible to make our markets much more lucrative, providing them better rate of interest, providing them good opportunities, and ensuring ease of doing business. Now let's see what does the economic survey say. So economic survey, as I said in this chapter, talks about India's FDI, balance of payment, India's trade performance, import and export, and again it is a very fact-filled chapter. So it starts with first India's performance in terms of trade in financial year 2025. Again, the financial year 2025 is still ongoing. It has not ended. So the figures that we have are not for the entire year. They are mainly for the first 3 quarters. So it says, number one, India's export has grown considerably, which is a very good sign. India's merchandise export has increased by 5.6% the first half of the year, which is a good thing because it was an era of global slowdown. Most of the countries around the world were not growing at a very fast pace. So in that surrounding, in that scenario, to have your export grow considerably, it's a very, very, very good sign. On the other hand, import grew but at a very slow pace, which again is a good sign. Less import means our trade surplus will increase, our balance of payment will become better. So import grew at only 0.7%, means our current account balance also increased. Then the trade deficit reduced because again more exports and lesser import. It reduced the trade burden. The things that we exported most included electronics, pharmaceuticals, and IT services along with chemicals. On the other hand, there were still challenges because of which we could not realize our true potential. As per the economic survey, the big challenge was the global supply chain disruption. We have discussed this earlier. Because of multiple crises around the world, the Ukraine-Russia crisis still ongoing, the Israel thing not sorted out completely, China being aggressive towards multiple countries. Because of that, the global supply chain disruptions still remain. And then Donald Trump coming in, and then he is now threatening a lot of tariffs on other countries. So the supply chain disruptions will continue in the coming months as well. The third chapter also talks about FDI, that is foreign direct investment. Now, the good part is India has always been a very attractive market, especially after 1991 reforms. It's a market that gives good returns to investors from around the world. So we saw FDI, about $49.2 billion of FDI coming into India from the first 3 quarters. The countries that got most of the money into India in the form of FDI included USA number 1, then Singapore, Mauritius, and UAE. Sector-wise, technology sector got the most FDI, followed by renewable energy, which is again a very good sign. Means the entire world is very hopeful and optimistic about renewable energy sector in India. That includes solar, that includes wind. All these things are a good way forward. Then FDI outflows also happened. I mean, many Indian companies also got their money invested in other countries. About $12.3 billion went outside India in the form of FDI. The government tried to improve ease of doing business as well by having better taxation policies, by giving a push to digital infrastructure as well, so that the investors can come in and can invest their money easily without many hassles. Along with FDI, we also would like to point out towards the FPI, foreign portfolio investors that invested their money into India. So portfolio investors mainly are those that invest in stock markets in India because they see a growing stock market, a booming stock market, hoping that they would be able to get good returns out of it. That comes under category of FPI. Although we had a lot of volatility, but India's stock market still remains a very strong stock market and a very lucrative one at that for most countries around the world. Net FPI inflows recovered to $3.1 billion in December 2024, means much more money coming in. Stock market also remained resilient, although there were fluctuations. The problem in the stock market is, unlike FDI, where investors can't all of a sudden take out all their money, in FPI, foreign portfolio investment, they can take out money at a moment's notice, and that can cause fluctuations. Let me also give you a difference between the two. This is not a part of the economic survey, but I wanted to give you background information so that you're clear about this idea. The difference between FDI, foreign direct investment, and FPI, foreign portfolio investment. So FDI, as I said, is investment coming in from a company to a company for company's ownership. FPI is mainly into stock exchange for buying bonds, etc. FDI are active investors, they are direct investment, and they have a high degree of control. While FPI investors do not have a very high control, but they are a very short market investment. They're just looking for easy returns. Wherever they think they are getting a better return, they will just leave the country, and that is why it's volatile. So foreign portfolio investments are more volatile as compared to foreign direct investments. Then, because our exports are improving, it's a good sign for a balance of payment as well. That means we have good foreign exchange reserves for import. As of Jan 2025, the most updated data, India's forex reserves are about $640.3 billion. It's a very good sign. Also, our current account deficit improved, because of which our currency also has stabilized, although it is degrading as compared to dollar, but it has reached a stable level. Also, India has maintained a sustainable debt to GDP ratio of 19.4%. We would like to decrease it, but as compared to many other countries, our debt to GDP ratio is still not as bad. So it's 19.4 right now. What is the government doing? As per the economic survey, the government has pushed a lot of reforms to boost this external sector, to invite more FDI. For example, we are trying to improve ease of doing business. Tax laws are being simplified. The government has emphasized on Make in India, PLI schemes to push production within the country. For example, iPhone manufacturing is happening in India at a very large scale. Companies such as Tesla are in talks with the government of India to set up huge manufacturing in India. For all that, the government is trying to incentivize them to come to India. We also have a lot of trade diversification. Our dependency on a few countries like China and US has reduced, and we have now signing trade agreements with multiple countries, multiple regions. For example, you would have seen in the newspaper, the UK minister, British minister has said that we are keen to finalize a trade agreement with India and we might sign it very soon. So India is trying to get as many trading partners as possible. At the same time, the economic service says there are a few challenges that we have to contend with for our FDI and FPI to remain strong. First, short-term risk. The biggest short-term risk, as per this chapter of the economic survey, is the interest rate globally are fluctuating, meaning that as soon as a better interest rate is offered in some other country, investments, FPI can come out of the country and go there. That's a big problem with fluctuations. There is rising protectionism. Many countries are now preferring to make in their country, preferring to put tariffs as Donald Trump is doing, and when one big country does it, it sets a kind of a domino effect. So trade protectionism can go against our exports because countries would not like to import Indian stuff. And then there are risks involved in the ongoing wars, the Ukraine-Russia crisis, the Middle East still not being settled. All these are short-term risks because of which our investment coming into India can be at a danger. At the same time, there's a long-term strategy that India is adopting as per economic survey. First, diversifying our global supply chain, making sure that we are not just dependent on one or two countries for our imports or raw materials, improving our logistics, export costs so that it's easier to get products from India, and making sure that our FDI investors are attracted towards India, hoping that they will get a better return and a stable policy. Please understand, whenever a company invests in your nation, in your companies, what they want is stable policies. It's not about high or low tax rates, it's mostly about stable policies. For example, if a company comes to India and they see the government is saying we'll put 10% tax on you, then they want that to be 10% for many years now so that they can plan accordingly. What they don't like is 10% today, 20% next year, 5% then 2%, then 30%. No. They want a long-term stable policy. So high or low tax rate matters, but what matters more is stable policy making. This was a summarized version of chapter number 3 of this year's economic survey. I have a few practice questions for you to see if you are able to digest this information. First, what was the main reason for improvement in India's trade balance in FY25? We just discussed. Higher import duties, growth in export, decline in import. This was the one. If you remember, our imports increased very slightly, less than 1%, while our exports increased considerably, close to 6%. So B is the correct answer here, because of which our trade balance improved. One more question. Which of the following countries were the highest or the largest contributors to FDI in India in FY25? We just discussed this. The data is not out for the entire year, but in the first half, the biggest contributor has been the US. Then Singapore, Mauritius, UAE, these are the countries that have been the largest contributors. One more question. What is the primary reason for the volatility in FPI inflows, foreign portfolio inflows to India in FY25? Weak banking regulations, high fiscal deficit, geopolitical uncertainties, or decline in domestic stock market returns. We discussed this. Why is it that the portfolio investments are coming and going? Because of global fluctuations, because of geopolitical uncertainties, because of changing policies in other countries and their central banks. Wherever the investors are finding a better deal, they're just going off there. This is why the answer here is C. This was our third chapter. The fourth chapter talks about within the country. The last chapter, as you know, chapter number 3 was about investments coming into India. Now economic survey in chapter number 4 talks about prices and inflation. As you know, inflation targeting has been a major concern for Indian government for many years. In India, targeting of inflation is the responsibility of the RBI, the Reserve Bank of India. They have their own monetary policy committee that makes sure that inflation remains between 2 to 6% in India. Very high inflation means the prices of commodities is increasing, which they would not want. And inflation below 2% also is bad because it means that the economy is not growing as much as it should. So this year's economic survey in chapter number 4 talks about how the inflation has been in India and what factors have contributed to fluctuations, increasing or decreasing inflation within the country, and some factors outside the country as well. This chapter also talks about inflation in different areas like fuel inflation, food inflation, etc. So let's break it down. Let's see what this chapter has for us. So as I said, chapter number 4 talks about all these things. Let's start with the key themes of this chapter. The first one being the global inflation trend. So it talks about how inflation has been globally. Now, inflation in simple definition means increase in the prices of commodities. Now, increase in price of commodities can be due to various things. Number one, there can be a sudden increase in demand that doesn't happen suddenly, or there can be disruption in the supply chain. Means, for example, because of Ukraine-Russia war, sunflower oil that is produced in very large quantity in Ukraine could not be distributed around the world. So the commodity, the supply chain disrupted, the supply was lesser, so the prices would increase. Similarly, food grains, rice and wheat, these are exported to the world from Ukraine and Russia. Because of their fluctuations, because of their war, they could not supply that to the world. So usually when you see fluctuations or when you see inflation around the world, it is mainly got to do because maybe there was a natural disaster that hurt those areas where there was production, or there are these global events such as war. This is what happened this time. So inflation around the world fluctuated, although it became better in 2024. In 2023 it was much higher. Supply chain disruption still remain a concern because Ukraine-Russia war is still ongoing. Inflation was better in US and EU specifically, so their central banks with that were taking out money from the market now became much more accommodative. There is rising price of oil around the entire world because of tension in the Middle East as well. But India benefited from this slowdown of inflation. So again, as compared to 2023 at least, in 2024 global inflation did slow down, because of which our domestic prices were stable. So it was a better year for inflation in 2024 as compared to 2023. Now, economic survey talks about inflation in the country. That was about international inflation or domestically. A few things. Number one, our headline inflation remains moderate, average 4.8%. Again, please remember the target of inflation that we keep in the country is 2 to 6%, and it is RBI's Monetary Policy Committee who has the responsibility to manage this inflation. Some other parts of inflation such as core inflation. So when core inflation is calculated, they don't consider food and fuel. This remained low because of a stable monetary policy by the RBI. Food inflation was a concern, means the prices of commodities such as food grains, etc., that remained high, volatile. Why? So mainly it was because the supply chain in agriculture was disrupted because of many weather events that disrupted the food production. So unseasonal rains affected vegetable prices. Because of unseasonal rains, some of the stocks got destroyed and the prices suddenly increased. Fuel inflation specifically was not very high because the government intervened in excise duties. So for example, if the fuel prices globally increase, the government reduced the tax so that end consumer would have to pay the same. So while the food was a concern in terms of inflation, in terms of weather events, fuel was not really a concern because the government handled that better. As I said, food price inflation was a major highlight that economic survey pointed towards. Economic survey said that vegetables, cereals, pulses, their prices remained high because of volatility. Government did take some action. For example, the government did have a buffer stock for rice and wheat, but still for vegetables you can't have a buffer stock. See, you can have a buffer stock for those products that have a long shelf life, so rice, wheat, etc. But then when they are perishable products such as vegetables and fruits, you can't store them for a long time, and that is why controlling prices in those food items becomes a very challenging task. Kharif and Rabi harvest were also the key determinants in deciding how the prices would be. So we struggled a bit on the food front. On the fuel front, it was not so much of a task, although the prices were fluctuating globally. But as I said, government did make some tax adjustments. Apart from that, one other interesting thing was that India continued to focus heavily on renewable energy, because of which we were able to reduce our dependency on fossil fuel. For example, as you know, our ethanol blending program is going on. We are targeting a 20% ethanol mixing with petrol by the end of 2025. We are en route to do that. So as we increase the blending of ethanol with petrol, obviously the import of petrol or crude oil will decrease. Although it won't happen immediately, but it is a long-term goal. Our focus on renewable energy has made sure that fuel inflation does not affect us as much as it used to earlier. What has RBI done? RBI for most part of the year maintained a tight monetary policy, means to suck out money supply from the market. As you know, it's basic economics. When the price of the commodities is increasing, usually what the RBI does, they try to take out money from the market. When you don't have enough money in your hand, you won't buy stuff. When you won't buy stuff, the prices will automatically decrease. How do they take out money from the market? By making it difficult for you to take a loan, by making it expensive for you to take a loan, by not giving banks enough free money to give you the loan. So that is what RBI did. For most part, the repo rate was at 6.5%, making it difficult for the banks to give loans, making it difficult for the people to afford loan from the bank. RBI's policy aimed at controlling liquidity while ensuring sufficient credit availability for the growth as well. So RBI tried to maintain a balance between growth and inflation, because see, the problem with this is if RBI takes out too much money from the market, then also it's a problem, because when people don't have money, they won't be able to invest, there won't be any growth in the market. So when RBI decides any specific repo rate or any other policy measure, they have to find a balance between inflation and maintaining growth as well. So they're doing a tricky job here. The economic survey, just like other chapters, in this chapter also talks about the risks that are involved. So there are short-term risks for inflation. The biggest short-term risk is the climate-related events, drought, floods, etc. You can't control them, and they can supply your food or your food production, so that will push the food prices higher. Oil, because we are still dependent on our oil supply, over close to 80 to 85% of our oil comes from outside. So any fluctuations in the global market will have an impact. And then global supply chain also could be affected, because all the spare parts of the machines or manufacturing, etc., coming from outside. Long term, what is the strategy? Strengthen our agriculture supply chain to make sure that we reduce the price shocks. It can't be done after a certain extent, because agriculture is something that is so weather related, weather dependent, and you can't really control over. Then enhance your storage infrastructure. Make sure that the food grains are not lying in the open as much as you can store, to reduce any fluctuation in the price, and expand renewable energy even more to make sure the fuel prices don't affect you. This is what the long-term strategy suggested by the economic survey in chapter number 4. This was the important takeaway from chapter 4. As always, I have a quiz for you from this chapter as well. Let's see how much did you digest. First, what was the primary driver of food inflation in India in FY25? We just discussed high MSP, supply chain disruption, vegetable and pulses, declining food production, or rising rural demand. What was the reason behind food inflation? We discussed it was supply chain disruption because of extreme weather events, because of which we did not have a stable output for vegetables, fruits, pulses, etc. One more question. Which of the following measures helped control fuel inflation in India? Again, fuel inflation. We talked about food, now fuel. Increased crude import, expansion of renewable energy, higher excise duties, or trade restriction on oil export. These are the two that we talked about. Higher excise duty, it was actually the opposite of it. When the global price of fuel increased, the government cut down on excise duty so that it is still the same price that the end consumer is paying. It is actually expansion on renewable energy. We discussed how we are pushing towards renewable energy, solar, wind, green hydrogen, etc., so that our dependence on crude oil reduces, so that we are not feeling as much shock of any increase in the global price of fuel. I have one more question for you for this chapter. Which of the following was a major risk to India's inflation outlook in FY25? High fiscal deficit, geopolitical conflict, and global oil price fluctuations, decreasing urban demand, overproduction in agriculture. Major risk to our inflation outlook means the projection of inflation that we had, what can put it at risk, what is something that is outside our control, that is geopolitical conflict and global oil price fluctuation. We don't have any control over it, So if something like this happens, or the war or the conflicts continue, it might have an impact in the long run, and an inflation targeting may go haywire. That is why the answer here is B. Let's begin then with chapter number 5 and its summary. So chapter number 5 is titled Medium Term Outlook, Deregulation Drives Growth. As the name suggests, it talks about what exactly is the government's aim for India in medium term. Medium term means not immediately in the next 1-2 years, and not after 20-30 years. It would be 5 to 7 years. That's usually the medium term case. So, for example, by 2030, where do we want to be? And it says that the government is thinking of deregulation to drive growth forward. Deregulation means the government should take a step back, try and push the private sector with investments, try and make it easier to do business so that this growth can go forward. This is the gist of this entire chapter. This is what the topic tells us. So let's see what does it have. So as I told you, this chapter mainly talks about how India will become a developed economy. As you know, the government's aim to have a Viksit Bharat is by 2047. That's a long-term goal. But how do we want to go there, or how can we achieve that? That is what depends on the medium-term strategy. So let's discuss the key themes from chapter number 5. First key theme, what are India's growth projections in medium term? Again, we are talking about projections, something that we are hoping for. IMF projects that India's GDP will reach $5 trillion by FY28 and $6.3 trillion by FY30. Now again, these are just projections. It may be overachieved, maybe underachieved, depending on what the reality is. On the other hand, if the government's own aim to have Viksit Bharat by 2047, if it has to be achieved, we need 8% growth, over 8% growth annually for the next 2 decades. So Viksit Bharat, the government's aim of Viksit Bharat by 2047 is not going to be that easy. It needs a pretty robust growth. 8% is not a growth that we have had in the last few years. It's been many years, in fact, that our annual growth rate has touched 8%, so it will take some hard work. Also, the chapter says that the global factors such as geopolitical risk, trade disruptions, etc. will impact our growth. See, we are living in a globalized economy. A lot of decisions that are outside our country, that are outside our purview, will impact our growth story as well. So, while the projection can be that we have to achieve a certain number by a certain year, but it may not always turn out to be that way because of a lot of global factors. Now, what are these global factors and what will be its impact on India? So, one big factor is that we are increasingly seeing globalization changing its nature. Now, globalization is being replaced by geo-economic fragmentation. Now, what do you mean by this? In simple terms, globalization meant that every country in the world will be open to trading with the other countries. Now what we see is countries are forming small groups and they are happy to trade within that group. ASEAN, EU, BRICS, SAARC. So we are seeing increasingly a lot of smaller groups emerging. So countries either preferring to have trade within these smaller groups, have free trade agreement with a bunch of countries and then trade within themselves, or maybe just focus on their nearby countries. So globalization now is moving towards something else. For example, there are terms such as friend-shoring and near-shoring. Friend-shoring means we'll only deal with countries or trade with countries that we consider as our friends. Near-shoring means we'll only trade with those countries that are considered to be our neighbors. So we won't be as open as we were to other parts of the world. This will lead into a lot of protectionist policies. Protectionist policies again mean that you put up barriers so that it's not easy for any product to come in from outside and then be sold into your country. You basically become a protectionist policy. India has to diversify its trade partnerships. We have to overcome this challenge. We have to find many more trade partners. And you have seen this. India, in the past few years, has signed multiple free trade agreements. India usually has not been known to be a country that is very open to free trade agreements, but that is changing. UAE, Australia, now UK, there are a few examples in India is trying very hard to sign these regional trade agreements. The other thing that economic survey says, the government will be should focus on deregulation as a key driver of growth. That's in the title of the chapter also, that the government should reduce its presence, should reduce the bureaucratic hurdles and make India a much more attractive business destination for both, for our own companies, our own corporates, and for companies from outside India who want to come and invest in India. Some of the re-regulation measures that the economic survey suggests to the government are: simplify the business laws to reduce compliance burdens. For example, you would have seen in Indian Supreme Court many companies coming in and filing a case that the government has demanded so much tax from us. Like Vodafone tax case was such a long stretch case. These are not desirable things. So government should reduce complications in the tax law. Doesn't mean you should not take tax, but you should simplify these laws. Faster clearance for infrastructure projects. You would have seen how infrastructure projects in India take such a long time because of clearing of files. It's a very long time taking process. Reforms in taxation to improve the business confidence, and flexible labor laws as well to boost job creation. For example, a lot of companies, while hiring talent, have to pay attention to a lot of laws. It's not easy to hire talent while adhering to all the laws. Many states, as you know, are bringing reservation laws, local reservation laws, such as Haryana government try to do it, Karnataka government try to do it by reserving certain jobs in the private sector also for the state's population. These things make it difficult for the companies to hire talent openly, freely, and that becomes a bit more challenging. So economic survey says that this also should not be done. Then the economic survey also talks about the role that has to be played by infrastructure in sustained growth. So government has to focus on building robust infrastructure, increase their capital expenditure. For example, the suggestions are: focus on expanding rail, road and port network. Renewable energy transition should also be the focus area to reduce our dependence on fossil fuel, and strengthen digital connectivity. All these are things that the government is already doing. But economic survey basically is trying to tell that the government is going in the right direction and they should give it a boost even further going forward if we have to become an attractive economy. One other theme of this chapter is have more confidence in the private sector. Government should take a step back, ask the private sector to lead R&D, to lead innovation in the country. The economic survey says that India must transition from a government-driven economy to a private sector-led growth model. Because see, all these new development, new inventions need a lot of money for research and development. The government may not be the best source of that money. It is the private sector that can bring in their expertise, that can bring a lot of these things into play. I'll give you a real example. Just today we had the news that BSNL, after so many years, for the first time has turned profitable. One of the things that they did was they hired a famous consultancy company called BCG that advised them what to do so that they can turn profitable. So BSNL turning profitable is also one of the things that BCG as a consultancy group pushed it towards. So when you involve the private sector and you take their inputs, their expertise, it does bring in better results, as we have seen. Then the government should go ahead with PLI, production linked incentive scheme, as the government has done. The government pushing the manufacturers to produce more, as a result of which they would be getting certain incentives from the government. This is what the idea and the nature of PLI schemes has been. The government should also make sure that its fiscal consolidation efforts are on track, means we should try and control our fiscal deficit. The gap between the spending and the earning should not be as high as it becomes unsustainable. The government should rationalize subsidies, means cut off subsidies wherever possible, have better tax revenue collection. And the government companies, PSU, some of them which are making humongous profits like ONGC, etc., should be reformed. HAL, for example, should be reformed so that our crucial sectors also are not held back because of the performance of the PSUs. One other very interesting thing in this chapter is about India-China. Now, economic survey in this chapter says that we are often compared to China, but there are key differences in our economic growth and China's economic growth. China's economic growth has always been driven by manufacturing. It is their manufactured products that are exported that have brought in so much revenue. For us, India has always been dependent on services related revenue. So most of our consumption or most of our export, the money that we earn is from the services led growth. So it's not the same. But India can learn from China's industrial strategy. So economic survey in a way has appreciated the Chinese model, their industrial strategy especially, and it says that India can also learn from that while adopting that to our own strength. So it's an interesting thing that economic survey talks about, comparing us to China and saying that we can also learn from them. In the end, just like every chapter, this chapter also talks about what are the short-term risks that can slow down our growth and what is the long-term strategy that we can adopt. So it says that in the short term, the growth rate could be hampered by reduced export demand. There is an increasing competition in the export market. Our competition is with many countries, including China. If that slows down, that will have an impact on economic growth. The geopolitical conflicts, because of which many trade routes may be shut down. We have an ongoing conflict in Israel. The Ukraine-Russia war has not stopped since many years now. Supply chain disruptions also can have an impact on manufacturing sector because we are dependent on many other countries for input material and for raw material coming in from other countries such as China. Long-term strategy, to have domestic innovation, give it a push that we are less and less dependent on the other countries, expand the investment in renewable energy, and promote ease of doing business. If all these things are done, maybe our aim to have a Viksit Bharat by 2047 will become a reality. This was chapter number 5 and its summary. Let me give you a few questions so that you can test yourself. First, what is a primary objective of India's medium-term economic strategy? Increase public sector employment, promote economic deregulation and private sector growth. This was the one, if you remember. One of the themes was the government should take a step back, give a push to private sector and have deregulation. This was a big aim. Next, what is a major global economic trend impacting India's trade strategy? So what is happening around the world that is impacting our trade strategy? Hyper-globalization, geo-economic fragmentation, friendshoring. Yes, this was the one, if you remember. Countries are moving away from globalization to trends such as friendshoring, nearshoring, etc. Making smaller groups, having trade agreements with a group of countries rather than opening up to the entire world. One more question. How is India planning to sustain long-term economic growth? Increase in dependence on subsidies? No. Strengthening industrial policy, promoting deregulation? Yes. This is what we are trying to do. Promoting deregulation, having our own policies which are attractive enough for others to come and invest in the country. Let's begin with what chapter number 6 holds. Chapter number 6 is titled Investment and Infrastructure, Keeping It Going. So in other words, it talks about investment and infrastructure in India, and it says that it has been good in the past few years and they just want to continue. Economic survey tells its suggestions how to continue on the same path. How can we have better investment? How can we have better infrastructure? So on and so forth. So let's see what does the economic survey tells us. So economic survey in this chapter focuses on our vision of a Viksit, that is developed Bharat by 2047. And it says one of the key things to achieve, or one of the key things that we need to do to achieve that is to focus on our capex, that is capital expenditure. So money that is spent on building hard infrastructure, roads, ports, railways, airports, etc. That is the money that is called as capital expenditure. On infrastructure that is long lasting, it will create jobs as well in the long run. So let's see what this chapter talks about one by one. First, this chapter talks about public investment and government initiatives such as the National Infrastructure Pipeline. Economic survey says that National Infrastructure Pipeline was launched targeting 111 lakh crore investment from FY20 to FY 2025. Under this, close to 10,000 projects under 37 subsectors are being monitored right now. And the good part is, as per the economic survey, the government has been increasing its capital expenditure. So infrastructure capex has grown at a rate of 38.8%, which is a very, very good thing. It's a positive sign because this infrastructure doesn't just bring jobs, it also improves the prospects of business in the long run. So it covers sectors such as energy, roads, railways, civil aviation, etc. All these have been covered under this project. Also, the chapter focuses on national monetization pipeline. It says that in order to attract more private companies to invest in these infrastructures, especially in the brownfield asset. So there is a greenfield asset. Greenfield project means when you're building something from the ground up, that is from the scratch. Brownfield means it's an infrastructure and asset that exists already. You are just improving that or you are just making it better. The National Monetization Pipeline was launched specifically to focus on the brownfield asset. Under this, 6 lakh crore rupees worth of assets were identified of how to monetize that, how to earn more money from that. 3.86 lakh crore of transactions were completed under this, and the target for this financial year is to monetize infrastructure worth 1.91 lakh crore. For example, look at railways, defense. These are ministries that have humongous amounts of land under them. In many of the cities, you will see big empty lands, and there will be a board that says this land belongs to defense or this land belongs to railways. So defense and railways are the largest owners of land in the entire country. So all that land, not all of that is put to use every single day. So how can that be monetized better? Can we use that for some other things? This is what the idea of national monetization pipeline is. Then this chapter also talks about the physical infrastructure built one by one. First, it talks about railways. So railways has expanded its blueprint, especially bringing in new technology in the form of Vande Bharat. Economic Survey says 17 new Vande Bharat trains were introduced in this financial year and 220 new coaches were produced. Railway tracks also were added. About 2031 kilometers of tracks were commissioned. Now please understand, when new trains are built and the trains may be capable of going at 180 kilometers per hour, but in reality they would not go beyond 100 or 120 kilometers per hour. The reason is the speed of trains is not just dependent on the train or the engine, it is also very much dependent on the tracks. So you have to keep on updating the tracks. When the tracks are very old, they can't sustain very high speed trains. It might lead to accidents. So not just building infrastructure in the form of trains, but redoing the tracks, making the tracks better, making them more advanced, that also is a constant endeavor. The government has been investing in electrification and modernization of stations as well. We still have a long way to go in achieving 100% electrification. A lot of the trains still run on coal, but this is a continuous endeavor from the side of the government. Then road infrastructure also has picked up. The road national highway construction reached 5,853 kilometers in this financial year. That is from April to December. This is the data that we have in this economic survey. As compared to last year in the same period, we had more highways built, but although we are not growing, but it's still an impressive number. So last year in the same time period from April to December, new highways of about 6,215 kilometers were built. Then we have the Bharatmala Pariyojana, that is again a lot of projects, lot of roads being built. Contracts of 26,000.5 kilometers, 26.5 thousand kilometers rather were awarded. The government has also been focusing on connecting important places such as Char Dham with these roads. So Char Dham Mahamarg Pariyojana has completed almost 3/4 of this entire length. So out of 825 kilometers planned, 620 kilometers have been completed in the Char Dham Pariyojana. Then ports and shipping, government has been focusing on this also. This is extremely important for your foreign trade. Import, export, all happens. Most of that happens with your ports, so they have to be robust enough. Cargo handling capacity has been increased. Sagarmala Pariyojana has also seen improvement in the infrastructure in the ports. We have also seen Vadhavan Mega Port, that is about 76,000 crore investment, and Tuticorin International Container Terminal, they were also launched. The Chabar Port is operational. We are expanding the capacity, but the Chabar Port being operational also gives a good way for India to expand its footprint beyond India as well. As you know, Chabar Port gives us access to Central Asia. So we can bypass Pakistan, we can reach Central Asia through Iran. That is also a good sign. The government has also been focusing on improving digital infrastructure. 5G rollout has increased significantly. In terms of ISRO, they also have been playing a major role here. ISRO's platforms such as Bhuvan, Nyaya Vikas, Amrut, they have all been helping in planning of infrastructure and developing better infrastructure. We also have the National Urban Digital Mission that was launched to improve data connectivity in the smart cities across the entire country. In terms of rural infrastructure, the government has been focusing on Deen Dayal Upadhyay Gram Jyoti Yojana, that is aimed at achieving 100% rural electrification, and Saubhagya Yojana. These have led to close to 3 crore new households getting electricity connections, mainly in the rural areas. Rural road connectivity also has been improving, allowing people to travel more, allowing people to go to jobs in an easier manner. Under Pradhan Mantri Sadak Gram Sadak Yojana, the infrastructure of the rural areas also has been in focus. Urban areas also have been the focus because of increasing population migration. RERA, that is Real Estate Regulation Agency, They implemented projects in 1.38 lakh registered real estate projects. Apart from that, Swachh Bharat Mission also improved sanitation, waste management in most cities across the country. Then Economic Survey says that climate smart cities framework, urban learning internship programs, all of these have been done in order to improve the condition of our cities. See, the condition of our big cities in the country has always been a matter of concern. A lot of our cities are burdened with humongous population. Many of them see issues of floods or drought or other kind of issues, sanitation not up to the mark. All of that requires long-term planning. This is what the government has been aiming for. In terms of power, renewable energy, this also has seen a drastic improvement. Economic Survey says that installed power capacity grew by 7.2% year on year, and it has reached about 456.7 gigawatts, which is also a good sign the government wants to achieve 500 gigawatts goal as soon as possible. Renewable energy increased 47% to total power capacity, which is again a very important number for the examination. It has not reached 50%, but it has about to reach 50% of our total power capacity. Solar and wind expansion continued with 209.4 gigawatts of installed capacity. So in terms of renewable energy, solar has been the most promising. Then we have wind, green hydrogen now being put into focus as well. Tourism infrastructure also was in focus. The Prashad and Swadesh Darshan initiative, they are supporting tourism from all across the world. 40 projects across 23 states were approved with interest-free loans for 50 years so that better infrastructure can be built for inviting tourists from outside the country and within the country. You know, Prime Minister also gave a call that people should try and visit within the country rather than being attracted to destinations from outside India. Space infrastructure also saw an improvement. Right now, India operates 56 active space assets, including satellites and navigation, communication, scientific purposes. Other projects in space sector include Bharatiya Antariksh Station, Chandrayaan 4, Venus orbiter mission that we have been working on, next generation launch vehicle that we have been working on. All these have seen great progress through ISRO. In the end, the chapter concludes by saying that our public investment infrastructure is increasing significantly. It is at 3.3 times the level of FY20. We have seen many challenges. We have not seen many private sector companies interested in spending money in this sector, but we have to ensure that the PPP projects, public-private partnerships, are given a push so that the private sector also brings in their money and expertise. The government has been focusing on integrated multimodal transport as well, connecting different modes of transport for better access for goods and for people as well. This was chapter number 6 and the main themes covered in chapter 6 of this economic survey. Let me throw some questions at you to see if you actually learned it. Which of the following initiatives is closely associated with with asset monetization? Bharatmala Pariyojana, Sagarmala program, National Monetization Pipeline or Swadesh Darshan scheme. We have discussed this. This is the National Monetization Pipeline. This is the one that focuses on bringing in more money using the assets that we already have. Which of the following is not a part of National Infrastructure Pipeline? Railways, Housing, Urban Affairs, Space Exploration, Renewable Energy. Not a part of National Infrastructure Pipeline. This is space exploration. So we have not opened a space exploration as such as a part of this pipeline. We are focusing on others, on how can we improve their asset or how can we make these open for multiple usage, but space exploration is not a part of it. Consider the following statements regarding National Monetization Pipeline. Number 1, it aims to privatize greenfield infrastructure asset to increase government revenue. No, we discussed this. This focuses on brownfield infrastructure projects. Greenfield are not focused here. Greenfield means you have to build it from the scratch. That is not the idea. The idea is to use the existing infrastructure. So first is wrong and you can eliminate number 1. The answer thus is B. It focuses on asset monetization, roads, power, coal, etc. It was launched in 2021. Second and third here are correct. One more question to go. Which of the following statements are correct about railway infrastructure in India? Number 1. The Vande Bharat train initiative is a part of government's push for faster and modern railway connectivity. Yes. Dedicated freight corridors aim to decongest passenger railway traffic, yes, so that on those trains, on those route, only goods trains will go. Passenger trains will not have to be stopped in between to be overtaken. Indian Railways has fully electrified all its railway routes in FY25. No, we are working towards it, but full electrification has still not happened. The answer thus is 1 and 2. That is A. The third statement is wrong. Full electrification has still not happened. This was chapter number 6. So we begin with chapter number 7. But before that, reminding you once again, if you're new and you did not know, I am running a questions marathon, which is a kind of a prelims crash course for 2025 on my own app, where I have over 40 classes where I discuss 25 questions in each class to cover the entire syllabus so that you can practice question answers and revise the syllabus. It is available on my Android app. You can download my app called Harshmeet Study Circle. I've given the link in the description of this video. Do check that out as well. And there are other courses available there as well. Let's begin then with chapter number 7. So chapter number 7 is titled Industry All About Business. So as it clearly shows, it talks mainly about the performance of industry in India. All aspects of industry, FDI that it is getting, MSME sector, what is it that the government is doing to make the business easier in the country. All these things are mentioned in this particular chapter. So let's begin with what are the key themes that are mentioned in this chapter number 7. It starts with global industrial landscape and where does India stand. So it talks about globally what is India's position, where do we stand as compared to other countries, and what is our contribution to the world economy. Please remember, all the data given in this economic survey is from the side of the government, so it is the most authentic data that you can quote. The economic survey says that India's share in global manufacturing is about 2.8%. When you compare this with the global powerhouse like China, their share in the international global manufacturing industry is 28.8%. Means more than 1 in every 4 things sold around the world actually are manufactured in China. So if 100 rupees worth product is sold in the world, 28.8 rupees of that is made in China, which is a humongous contribution. Agencies such as IMF and UN Industrial Development Organization, they say that manufacturing is shifting towards emerging economies now, particularly China and India. Now, we were hoping that when COVID-19 pandemic struck, many companies would opt out of China, they would come into India, but we have not seen that shift. Although there is a gradual entry of many big companies coming into India, but it has not been at a pace that we had hoped for. There are many challenges that still remain in India's manufacturing sector, including the geopolitical tension. We have discussed about this earlier as well, leading to supply chain disruptions, ongoing wars, conflicts, countries imposing tariffs on each other. That has led to disruption in the supply chain as well. Now, there are certain industrial growth trends in India that this chapter talks about, means what has been the growth of industry in India. So it says there are key sectors that have led to stabilization of industrial growth, means that have led the industrial growth in a positive manner in India. Those sectors include steel, cement, chemical and petrochemicals. Then there are consumer focused sector like automobiles, electronics, etc. These are the ones that are doing very well for India. On the other hand, the problematic part is that in the first half of the financial year 25, it is the ongoing financial year, in the first half, manufacturing growth slowed down. Why? The reasons that this survey gives: number one, there are global trade uncertainties globally. As we have discussed, many countries are opting for a protectionist policy rather than being open. That has led to slowing down of trade. There has been supply chain disruptions, monsoon related disturbances, because of which the food production specifically has not been as expected, and then there are seasonal factors as well. There are also many business surveys and purchasing managers index that say that in the second half of this financial year, situation would improve. So we have seen optimism in the second half. We are hoping that it will improve coming forward. These are the numbers that are showcased in the economic survey. That is the manufacturing sector, how has it grown in the past few years. So financial year 21, it grew at 9.2%. Financial year 22, it was 11.1%. 23, 24. So financial year 24 was a decline. Financial year 25 is estimated to be better than the last year. But if you compare with the last few years, it's still a downturn. So we are estimating that by the time when the financial year ends, our manufacturing sector growth specifically would be 6.8%. Then the economic survey also focuses on research and development R&D. For a very long time, R&D has been a painful area for India. The reason being that R&D is a sector that demands a lot of investment, demands a lot of money to be spent. The government for a long time has been pushing the private sector to come and invest, because research and development, the investment that goes in there, is a major driver to the growth of any country's industry. The industrial R&D in India remains very low still, although the focus has been on certain sectors. For example, pharmaceutical is where most of the R&D has gone in. With increasingly new diseases coming in, the companies also are focusing on making sure that they are pushing a lot of R&D into pharmaceuticals. IT, transportation, defense also has seen certain R&D. There are certain challenges in R&D, research and development, as per this survey. For example, lack of research for commercial applications. So there is anyways lack of money being spent in research, and the money that is spent, lot of it is not practically usable by the end consumer. Low private sector participation, as we discussed. Private sector does not think it is the best use of their money, because there are high chances of money going to waste, and dependency on public sector. The government has started many initiatives to boost R&D. For example, PLI schemes, we have discussed this earlier. The government is pushing companies to manufacture more, in return get incentives from the government, tax benefits for R&D spending, and some incentives for startups and MSMEs as well, who are investing in innovation. The government is happy to give them tax breaks in the long run. Whether or not these will bring in the desired effects, it's a time taking process. We have to see in the coming months. Then there are certain business reforms that the government has been taking for industrial growth in India. The survey gives certain examples. For example, number one, the government is focusing on deregulation and ease of doing business. Means the government is taking a step back, making it easier to do business. There are certain states that are doing better than others. As per the economic survey, the business reforms across the states have been different. For example, there is a business reforms action plan, according to which Maharashtra, Gujarat and Tamil Nadu have performed very well. Then there are other states also that have the potential to perform better. Bihar, Jharkhand, UP, that are usually laggards, but they are expected that they have the potential to perform much better. There are certain states that have shown very, very appreciable reforms in labor laws, such as Andhra Pradesh, Karnataka, Haryana. They have relaxed restrictions on night shift for women in IT industry, so encouraging more women to come out and take part in the workforce. Then for investment purposes, some regulations have been reduced, have been softened, so that approvals for the factories, approval for manufacturing, etc. becomes easier, and companies won't have to wait for a very long time before setting up their manufacturing plants. This again is a data from economic survey. It tells the different scores that the states have achieved in their ease of doing business. So Maharashtra scores the highest, 92. The highlights of Maharashtra are fast track approvals and tax incentives to new companies. Gujarat again very close to Maharashtra, 90. They have given land bank for industries and ease of credit. So Gujarat government is openly giving out lands to the manufacturers, which is a very difficult process usually. Acquisition of land has always been a big stumbling block before any company can start manufacturing in India. Tamil Nadu, Karnataka, Bihar, these are the ones that have been pointed out as good performers when it comes to ease of doing business amongst the states in India. A special section has also been written on MSME, the micro, small and medium enterprises, because this is where most of the employment comes in India. So the government has been focusing on the MSME sector for a long time. Let's see what the economic survey says about this. So economic survey says that 23.24 crore people are employed in this sector as of November 2024, which is a humongous number. The government has started multiple initiatives for the MSME sector. For example, you have the Udyam registration portal, where the MSMEs can register themselves with least amount of paperwork. We also have the Udyam Assess platform, which has held close to 2.5 crore MSMEs to get access to formal credit. The one problem that MSMEs have is they are not getting loans from the bank because they don't have proper registration, proper paperwork. So once they register on this portal, they get a formal structure and it is easier for them to get credit from the bank. Then the government has also started credit guarantee scheme for MSMEs. The government has infused 9,000 crore rupees here for them to get loans. Additional 2 lakh crore credit has been given at lower interest rate, and the credit limit has been increased from 2 crores to 5 crores to have easier access of funds. The government also has given a push to trade receivables discounting system. So it's a simple to understand this. Let's take this idea. Let's say I am a company and I have sold products worth 100 rupees, but when I sell products worth 100 rupees, I don't get the money immediately. So the wholesaler that I've sold it to, they will tell me I will give you money after 2 months when I sell this product further to the retailer, to the consumer. So in this between, I have to go to the bank and get loan to manufacture more. So when the bank asks me for a guarantee, I will tell the bank that, see, I have receivables that I will receive this money in the next 2 months because I've already sold this stuff. So that system enables the MSMEs to actually get better loans. So it enables timely payment to MSMEs by large buyers. The auctioning system also allows them to improve this scale of cash flow. For example, they will be able to auction their bills to others who can say that, okay, I will take the money, you take the loan from me. FDI also has been boosted in this area. Although there are certain challenges in industrial trade, we still are highly dependent on import of many commodities in India. Coal, capital goods, chemicals are still imported in large numbers in India. The government is trying to improve our competitiveness. For example, the government is trying to expand the Export Credit Guarantee Corporation. The government has been signing multiple free trade agreements as well. PLI schemes have been expanded. All these are done with an intention to boost FDI coming into India. Capital coming into India will always have a positive impact on the businesses. As per the economic survey in 2025, the FDI, foreign direct investment coming into India, has been distributed like this. Manufacturing has seen the most FDI, 30%. IT and other services have seen 25% FDI coming in. Pharmaceutical about 15%. Automobile 18%, etc. In the end, the economic survey chapter number 7 talks about how the government continues to increase its focus on R&D, although we are still lagging behind as compared to some of the other countries. The amount of spending has to increase. The global slowdown in the trade is out of our control, but we have to increase our own consumption. We have to sign free trade agreements so that the global shocks do not impact us as much as they would usually. This was the summary of chapter number 7. I have a small quiz for you to test yourself. First question: which of the following sectors has contributed the most to India's research and development? India's industry research and development means which is the sector where most of the money has gone in R&D. IT, pharmaceutical, automotive or textile. We did discuss about this. Most of the money in R&D has gone to pharmaceutical because the companies are expecting that we might need new medicine, new vaccines in the coming few years. So a lot of research is going into pharmaceutical. Second, what is the main purpose of Business Reforms Action Plan BRAP? To enhance digital infrastructure to rank the states based on ease of doing business reforms. This is the one, we discussed this. Maharashtra ranks number 1, then comes Gujarat, then states such as Tamil Nadu. In terms of how easy is it to do business in these states, this is written in the Business Reforms Action Plan. So answer here is B. Next, the Udyam Assist platform was launched to help large enterprises to avail low interest loans, MSME to get government subsidies, informal micro enterprises to formalize and access credit, large exporters to navigate trade policy. We discussed this. The Udyam portal, also the Udyam Assist platform, it helps the MSMEs that don't have a formal structure to formalize themselves and have easy access to bank loans in the coming years. One more question to go. Which of the following statements about MSMEs in India is correct? MSME sector contributes more to employment than agriculture. No, agriculture employs many more people. The credit guarantee scheme has increased the credit limits from 2 crores to 5 crores. Yes, this is the one. We discussed about this. The government has increased the credit limit that will be given to MSMEs from 2 crores to 5 crores, further giving a push to MSME and access to credit. This is the correct answer. This brings us to the end of chapter number 7. We have already done chapters 1 to 7. I hope you have watched all of those. This is a turn of chapter number 8. Chapter number 8 is titled Services Sector, the New Growth Engine. As you know, over the past few years, in fact, more than a decade now, our growth has mainly been led by the services sector in India, mostly the IT industry, and this is where this chapter of the economic survey focuses on. They talk about how the services sector has led India's growth, the rate of growth, the challenges that this sector is facing, and where do we stand in the world as compared to the other countries when it comes to IT sector. Also, within the services sector, there are many important subsectors, not just IT, so it focuses on that as well. Let's begin with what this chapter talks about. So, in the introduction, it says that the services sector contribute 62% of the global GDP. So, globally also, services sector is by far the biggest contributor to the global GDP. It has been a major driver of growth, not just in India, but in many other middle income countries, in Asia as well, Thailand, Philippines, China, etc. Around the world, if you rank India in terms of the contribution the services sector, we rank 7th globally. 4.3% of the total global services export comes in from India. Now, there are two ways to look at it. Obviously, it's much better than manufacturing. If you remember in the last chapter, we discussed 2.8% of global manufacturing happens from India. Here, our contribution is much more. But then the types of things that you hear about India's service sector, you expect it to be a bigger contributor than 4.3%, but we still have a long way to go. Due to global uncertainties, our services sector has not been able to grow as much as it should, but still it is a big contributor to our national GDP. Now, this economic survey chapter talks about the performance of different sectors in this service sector. So it says that the total gross value added in the services account for 55% of India's total gross value added in this financial year. Some of the sectors within the service sector that have made the biggest contribution include trade, repair, hotels, then transport, storage, communication, financial services. All of these are part of the services sector. Our service sector growth after the pandemic has been at 8.3%, which is much better than the growth that we had in the pre-pandemic level. So we have regained completely from the shock that the pandemic gave us and the entire world, especially in the services sector. In terms of how the growth has been divided in the service sector, real estate, professional services, 20% growth has been seen in terms of the gross value added. 18% trade and hospitality, 15% financial services, so on and so forth. All these are part of services sector in the country. Services export, India has been exporting quite considerably in the services sector. Our exports in terms of services have grown at 11% in the last decade. So from financial year 2014 to 2023, the services export grew at 11%. The biggest contributors, you don't have any, I don't think there would be any trouble in guessing that. The biggest contributor in our services sector export has been computer services and business services. This is where IT and consultancy comes in. India is the second largest exporter in telecommunication, computer and IT services. We are third in other business services export, and also travel and transport has also seen a significant contribution from India in terms of exporting value. This is the number. In the past few years, how our services export has grown. So financial year 21, 7.5%, then 11.2%, 9.8, 10.5, and as you can see, our estimated growth this year will be the highest in the last 5 years. So we are again estimating. Why estimating? Because the time that the economic survey comes out, we have still not completed the financial year. The financial year comes to an end on 31st of March. So the data that we get in the economic survey is from 1st of April to 31st of December. So this is the data that comes in. They thus make an estimate of the remaining 3 months in this financial year. So the estimate is that our services export this year will grow at 12%. The economic service chapter 8 also talks about purchasing managers index in the services sector. HSBC is the one that comes out with this index. HSBC India Services says that PMI has remained in expansionary phase for 41 consecutive months. Now, what is the expansionary phase? So PMI, Purchasing Manager Index, has a rating from 0 to 100. If you are above 50, that means you are in the expansion phase. So your demand of services is increasing. Less than 50 means you are in the contraction phase. So this index remained above 60 for the first 5 months, which indicates that in the services sector specifically, our demand is increasing and it's a good sign. This is how the graph looks like. If you are above this 50 line, that means you are expanding. If you are below the 50 line, that means you are contracting as per the purchasing manager index. How has the financing been? Because all these services need a lot of financing. The banking credit to these services sector has been robust. It has stood at 48.5 lakh crore as of November 2024. So access to bank credit is not really a problem in the service sector. It has been growing at 13% year on year. Computer software professional services have received the highest credit growth, means highest loans are available to them. FDI inflows have also been significant. They have reached $5.7 billion from April to September financial year 25. Most of the FDI coming into this sector has been in the insurance sector. 62% of the total FDI, foreign direct investment coming in, has been in the insurance sector amongst the service sector. Then financial services have received 18% FDI coming into India. This is the breakup of the FDI coming into India services sector in FY25. Services sector, insurance sector rather, by far the biggest receiver. Financial services, IT. So IT doesn't receive a lot of FDI because they don't require it. The companies are very well balanced, established by themselves. They earn huge profit themselves, so they don't need it. Insurance sector, yes, it has received a lot of FDIs. Growth in IT and business process services has also been pretty impressive in India. India has grown its global capability centers from 1430 to 1700 in this financial year. Our employment also stands at 1.9 million professionals. India has about 28%, so more than 1 in 4 of the professionals working in STEM are in India. So STEM basically science, technology, engineering, mathematics. These are the areas which are driving the world's growth innovation forward. 28% of those professionals come from India. A lot of other Indian sectors have also seen adoption of AI in a pretty impressive way. That also has been mentioned in this year's economic survey. The economic survey also says that the government's push towards ONDC, Open Network for Digital Commerce, is impressive. It is a kind of an open platform where services can be listed without giving any commissions to any big private player. The logistic services have also improved. They have become digital in a much more impressive manner, meaning that it has become easier for the services to be mentioned and to come online and sell their services. In the end, it talks about what are the challenges and what can we do further. Like other chapters, this chapter also talks about global challenges, the global trade slowdown, which can threaten India as more and more countries go towards a protectionist path. Our export of the services can be impacted. There's also rise in AI, because of which the service export like IT etc. might come down. We need to reskill ourselves, and also there are offshore regulations, compliance issues. For example, let's say the US decides that we don't want to give H1B visas to the professionals anymore, or European countries make it difficult for the professionals of country like India to come and then trade. That becomes difficult. So our services sector, because it exports quite a lot, we are dependent on the regulation of other countries as well in the long run. These are certain challenges. This was chapter number 8 that focuses mainly on the services sector. Now, based on that, let's test yourself with a couple of questions. First, which of the following sectors contributes the highest to India's services export? Transport services, business and professional services, financial services, and travel and tourism. The answer is business and professional services. IT sector is a subpart, or IT services, a subpart of business and professional services only. We did discuss this. One more question. Which initiative focuses on digitizing India's e-commerce and services sector? Digital India Mission, Startup India, ONDC, Smart Cities Mission. We discussed this. This is the government's ONDC, Open Network for Digital Commerce initiative, that is aimed at democratizing e-commerce space. This was chapter number 8. This chapter, it is the chapter number 9 of economic survey, focuses on agriculture. It tells about the status of agriculture in India, the growth, the initiatives that the government has taken, what is it that we need to do to expand it even more. This chapter is titled Agriculture and Food Management, Sectors of the Future. Now, as you know, agriculture by far is the largest employer amongst all the sectors in the country. However, despite giving employment to so many people, its contribution to the GDP is not in proportion to that. So that is a major cause of concern. Many more people are working in agriculture as compared to the number that it requires. That means that even if you take out many people, it would not impact the productivity. But anyways, there are many people working in agriculture in India. So the government of India is trying to push them away from agriculture and engage them in some other activities. So this chapter mainly talks about how the agriculture sector continues to be the backbone of India in terms of employability, especially. It contributes 16% to our gross value added, but it employs over 46% of our total workforce. The problem with agriculture is that it is dependent on a lot of factors which are outside our control. Supply chains, climate change, input cost, and then the cost of the product that they're actually selling in, because of which we have seen farmer protest in various parts of the country on various issues, because it remains such a contentious issue. Anyway, so let's see what are the key themes that this chapter talks about. First, it talks about the agriculture growth trend. So it tells about how the growth has been in the agriculture sector. So gross real value added in agriculture has been 3.8% in financial year 25. This growth in agriculture has been slightly lower as compared to the last year, which is not a good sign. So again, please understand, agriculture sector has grown. It's not that it has not grown, but the rate of growth is not as high as it was in the last year. The total food grain production, the total food that was produced in India, is about 333 million tons, which is very good. Pulses, oil seeds, which go at a higher price, witness highest growth, which is also a good thing. Also, the government has been pushing the farmers towards horticulture, cash crops, which can be sold at a good price. So horticulture, dairy, fisheries, that have also gained momentum. For example, India is looking to export a lot more fishery products as compared to what we used to do earlier. If you look at agriculture sector growth, this is how the sector has grown in the past few years. So the estimate of this financial year is that we will end at 3.8%. So as compared to last 2 years, the jump is not as much. So we are decreasing in terms of how much we grew in the last 2 years. But if you look at some ballpark figure, it remains close to 4% almost every year. So in that sense, it's not really an outlier, but yes, you would have liked to see a better jump here. Food grain production this year has been more than last year. Not a high jump, it still remains the same ballpark, but at least we are growing. So as we discussed, the total food grain production estimated this year is 333 million tons. It's an estimate unless something really drastic happens in the last 3 years of the month. This is an estimate. It's better than last year, and then last year, and then last year. So it's basically an increasing trend. Now, please understand, from the economic survey, apart from the actual numbers, these kind of questions are also asked. So UPSC, for example, can say that since financial year 21, year on year, our total food grain production has been increasing. So they will not give you the actual number, but they'll just say that there's an increasing trend. So it is correct. There's an increasing trend year on year in terms of total food grain production in terms of million tons. So it's expected to increase this year as well. Now this chapter also talks about the policy initiatives that the government has taken specifically in the field of agriculture. Let's start with the first one, Pradhan Mantri Kisan Samman Nidhi, called PM Kisan Yojana. As you know, under this, the government has a direct cash benefit transfer to the farmers. Total 2.7 lakh crore were transferred to 11.5 crore farmers since the scheme started in 2019. The objective is that 6,000 rupees annually will be given to farmers in 3 installments. So it's an installment of 2,000 rupees each that will be given to the farmers. It's kind of a universal basic income kind of a thing for farmers specifically, that they would have this much support of roughly 500 rupees per month or 6,000 rupees per year, so that their basic requirements are met. Other reforms also include digital agriculture and market reforms. So the government is giving a push to ENAM, Electronic National Agriculture Market, meaning that they would not have to physically transfer their goods. Because what happens, think of it from the point of view of the farmer. A farmer, let's say, has 1000 kg of produce, and they hire a tractor or a truck to take it to the market to sell it. Now, just to transport this to the market, they have paid cost to the tractor or the truck. So they are under the pressure to sell it today itself, because if they don't get a good price, they'll have to bring the product all the way back, again pay the fare to the tractor or the truck, and then again take it the next time around. So they're under a lot of pressure to sell it, and the buyers know it, so they suppress the price. So this is where the digital markets come in. AI driven crop yield prediction models have also been used. This is a part of precision agriculture. This is important so that the estimates of the growth can be much more accurate. Banks also rely on all this information to give out loans to the farmers. Other scheme introduced by the government is called PM Pranam scheme. The aim mainly is to reduce chemical fertilizer dependency. As you know, the government of India gives huge agriculture subsidies mainly in urea, and when you get something at a cheaper price or at almost free, then you tend to overuse it. So government has been trying to pull the farmers away from overuse of these fertilizers. So what has happened is nano urea has been adopted increasingly. 28% increase has been seen in the adoption of nano urea this year. So traditional fertilizer and has reduced, which is a good sign for the government. There's also a lot of research on biofertilizer, organic farming also under National Mission for Sustainable Agriculture. All these things are being done so that the government can actually ensure that farmers come away from these chemical fertilizers and focus much more on precision farming. These are details of PM Pranam. It stands for PM Program for Restoration, Awareness, Generation, Nourishment and Amelioration. So this is the idea. I'll give you some other details as well. This is the package of this scheme. The urea subsidy scheme will be continued for about 242 rupees per 45 kg bag for 3 years. Eventually, the government wants to push the farmers away from traditional fertilizer and then focus on nano urea and other more effective fertilizers. The government also is focusing a lot on export. India ranks as the world's largest exporter of rice. About 38.9% of global rice trade happens through India. So it's a very dominating position that we have in terms of rice. Total agriculture export was about $55.2 billion this financial year. And the processed food export is also growing at a very fast pace. Now, some of the challenges are that at times when the government thinks that the prices of these commodities are increasing, the government puts restrictions on the export. So for example, the government can put restriction that the farmer cannot export rice or onions, because when you export it, the quantity within India would decrease and it will lead to price rise because of high demand. Now, it's a good thing on one hand when the government puts restrictions on export so that the prices can be controlled, but from the farmer's point of view, it's not a very positive thing. Think of it this way: when you are buying onions at a high price, it may be costly for you, but that's beneficial for the farmers. So whether the government should just allow the market forces to continue and decide the price, or whether the government should intervene and then put restriction on export, that is also a big debated point. Then the government has also reformed its export policy. Agriculture Export Policy 2023 aims to boost the processed food export by 25% by 2030. The government is also focusing on areas such as West Asia and Africa so that more exports can be expanded. Right now, our export mainly focused on Europe, Asian markets, America, etc. The government has also been giving a push to farmer producer organization, the FPOs, so that they can collectively bargain and have a better price for the farmers when they export stuff. At the same time, there are many challenges in Indian agriculture that the government has to focus on. The economic survey points out the first challenge: climate and weather uncertainty. That is a big problem with agriculture. It's so much dependent on nature and natural aspects which are outside your control. You can't really do much if there is lack of rain or there is too much rain, floods, heat waves. And due to climate change, these events will only increase rather than stopping. IMD predicts a 12% increase in extreme weather events. That means that we have to do a lot of research in introducing new variety of crops that are drought resistant, that don't require a lot of water or can survive in flood like situations. So that is a big concern. A lot of research and development is going into it, how to make crops that are resistant to these erratic weather conditions. It's not an easy thing, it requires a lot of money, but the government is working towards that. The government is also trying to improve market access and reduce price volatility. For example, international wheat prices have fallen, fluctuating MSPs, they create a lot of instability for the farmers. Because see, these commodities and their prices are not fixed. At what price will the commodity be sold depends a lot on the demand and supply in the market. Thus, the government is also trying to bring technology into play as per the economic survey. ENAM, then grain aggregation models, all these are being done so that a transparent price can be offered to the farmers and they don't fall prey to these big corporations that try to suppress the price. At the same time, there are many startups in the agriculture field that are getting a lot of funding. This also is something that the economic survey talks about. Economic survey says that many technologies such as drones, smart irrigations are being deployed. We have seen 30% increase in adoption of Kisan drones for spraying of pesticide, which is much more effective. It reduces the physical labor also of the farmers. Smart irrigation systems are used to have much better water efficiency. Their rate of adoption is increasing by 40%. When you have smart irrigation means you only use the water specifically for the plant and you reduce the wastage. That has led to a lot of improvement in the groundwater depletion problem. There are solar powered micro irrigation pumps under PM Kusum scheme, which again plays a good role in making farming sustainable in India. These are some of the things that we have seen in technology or we have seen in agriculture which are using technology. Kisan drones, adoption rate 30%, smart irrigation 40%, nano urea, ENAM digital mandis, AI crop monitoring, all these things are again some things are these things are examples of technology coming into play in the field of agriculture. Then as I said, there are many agriculture based startups. Over $1.1 billion in funding was given to agri startups, which is a good sign. They are here to do a lot more research and development in the field of agriculture. A lot of them are focusing on supply chain digitization, smart irrigation, etc. FPO, that is Farmer Producer Organization, their contract farming has also increased by 24% year on year. That allows the farmers to sell directly instead of being dependent on the middlemen. These are again things that are working well for agriculture. Similarly, related sectors such as dairy, fishery, horticulture have also been growing. Dairy contributes 28% to the agriculture GDP, which is a big number. India, as you know, is the largest producer of milk in the world. Then we have the fishery sector that has also been seeing a growth. It's a pretty dominant export sector in the country now. PM Sampada Yojana also focuses on that. Horticulture production has also exceeded 340 million tons. Means a lot more vegetables, spices, fruits are being produced, which is a good sign because there's a lot of demand of high quality such items around the world. What is the future course of action? First, try and have products, seeds, etc., which are resistant to erratic weather conditions. So, a lot of research and development has to go into climate resilient agriculture. A lot more technology has to be used in innovation, decision making, etc. And there has to be emphasis on food security. Farmers' income has to be stabilized. We have to ensure that the farmers have a clear indication of how much they can earn. MSP alone will not be able to work together. Let's see if you were able to understand the gist of this particular chapter. I have a test for you. First question: which scheme is aimed at reducing India's dependence on chemical fertilizer? PM Kisan, PM Pranam, ENAM or Soil Health Mission? We discussed this. It is a PM Pranam scheme that is aimed at reducing chemical fertilizers and their consumption. Next, which technology is being increasingly adopted for precision farming in India? Blockchain, nano urea, Kisan drones, all of the above. Precision farming, all of the above. All of these are being used. Blockchain is being used to assimilate a lot more data to help the farmers with their prediction methods of how the weather would be or what kind of crops would help them achieve a better outcome. All of the above are being used. One more question: which agriculture scheme focuses on improving digital marketplace for farmers? Which is the marketplace scheme? The ENAM, National Agriculture Market. We discussed about this earlier as well. This is the scheme. This was chapter number 9. Chapter number 10 is based on a new theme which is called external sector managing global headwinds. So As you know, every single chapter is based on a certain theme, some on services, some on agriculture, some on various other sectors. This one is mainly focused on what is happening outside the country, our interaction with the world. So it focuses on our exports, our imports, how can we make it better, where are we right now, and what growth can we expect going forward. It also talks about how India's debt has been trending, is it increasing or decreasing, especially as compared to the forex reserves we have. All of that has been mentioned here. So in short, the summarized version as given in the intro is our total export reached $602.6 billion in the first 9 months. Again, we are only focusing on the first 9 months because the data in this year's economic survey or any economic survey is only till the end of December. Jan, Feb and March, that is not accounted for. It will come later on. So in the first 9 months of this financial year, total exports reached over $600 billion, which is a growth of 6%. Total imports at the same period were more than the exports. So please remember, net, we still have a trade deficit. Net, we import more than what we export. Our imports in the same time period were about $682.2 billion. This has also been growing. So both have been growing, import and export. Let's see our trade numbers more closely. So the economic survey, chapter number 10, tells us about the global trade environment, how it remains challenging. And we discussed earlier as well, why is global trade challenging right now? Number one, there are ongoing disputes, ongoing issues, including wars in various parts of the world. We have also seen protectionist policies. Add to that, we have also seen that shipping has not been very safe. We have seen the Houthis from Yemen attacking multiple merchant ships, especially in the Red Sea, in the Strait of Hormuz, and that remains challenging. So, risk in Red Sea, Strait of Hormuz has affected shipping because now ships have to take a much longer route. So, longer route means more money has to be spent and the cost gets passed on to those countries that are buying. So, energy prices have increased because of that. Supply chains have been trying to shift from China to India and towards Southeast Asia, which is a good sign for us. Although it's not a very quick shift, but yes, we do see increasingly many companies showing interest towards shifting their base from China to India. Total exports, as we saw earlier, are about $602.6 billion in the first 9 months. The key things that we export are non-petroleum and non-gems jewelry exports that have grown by over 10%. Textile exports have remained sluggish, means not that high, because the demand has slowed down. And in textiles specifically, we also have competition from countries such as Vietnam, Bangladesh as well. In terms of FDI, FDI has increased year on year. This year we saw a growth of close to 18% in the first 9 months or so. Net FDI inflow declined due to increased repatriation and disinvestment by foreign investors as well. Apart from that, there are specific sectors that got more FDI than others. For example, sectors such as technology and software services got a lot of FDI, followed by renewable energy, manufacturing under PLI, etc. Apart from FDI, money also comes in the form of FPI, foreign portfolio investment, that mainly gets into the stock market. That by nature is volatile. Stock market inflow, outflow depends mainly upon the rate at which the capital is growing. If the investors find better avenues, they obviously would not hesitate to take the money out. That's why it remains very volatile. So FPI, foreign portfolio investments, have remained volatile as compared to other forms of investment. This is where FDI has been focusing on. 32% FDI share has been in technology and software, 18% renewable energy, then manufacturing, pharmaceutical and automobiles. This is how FDI has been targeted. What about our trade deficit and service surplus? So in the service sector, we obviously export much more than we import, so we obviously will have a surplus, but it's not as wide as to offset our trade deficit in terms of goods. Merchandise export trade deficit widened. We had much higher imports, especially in electronics, energy, etc. India ranked 7th in the world in terms of services export. We read that in the last chapter as well. We accounted for 4.3% of the total global export. The major exporters or major commodities exported from India include IT services, business consulting, etc. Remittances means money coming in from Indians living outside. India is the highest recipient of remittance around the world. That continues to support our external balance. So because of which India does have a robust foreign exchange reserve. This is how our imports and exports have been growing over the years. So as you can see, exports have been growing over the years, although financial year 25 exports, the growth has slowed down considerably as compared to last few years. Similar is the case with imports. So, exports growing down or export going down is not always such a bad thing. Maybe the consumption within the country has also increased. So if a company is making a lot of products, maybe it is consumed within the country and not being exported. So yes, there is a decreasing trend in import and export, both of them. So trade deficit has not expanded that widely. About foreign exchange reserves, again, it's extremely important for us for having a stable currency that you should have significant foreign exchange reserves. India's foreign exchange reserves stood at about $640.3 billion by the end of December 2024. Now, usually foreign exchange reserves are always compared with the external debt that the government has. It's ideal that foreign exchange reserve should be higher than the debt that you have. In India's case, we are obviously not higher, but we are somewhere in the vicinity. So we have about 90% of the total external debt in the form of foreign exchange. So our total external debt right now is $711.8 billion, while 90% of that is the foreign exchange that we have. So we are not that unstable if it comes to giving away or if it comes to returning our foreign debt. Rupee, however, has remained stable despite low global volatility. So you might say that value rupee is declining, it's depreciating, it is, but it's not that volatile. We do still have strong forex reserves. We have capital inflows, remittances have also been very steady. So this is again a pattern that we have seen in the past few years. So FY 2021, this was our forex reserve and this was our external debt. So you can see it's similar kind of a pattern. 90 to 95% is what we usually maintain. That our forex reserve is usually 90 to 95%. So it was the closest somewhere here and remained the same in the next year as well. Then the gap started to increase, but again, it's not such a high gap. We are still 90% in the vicinity of the external debt that the government has. What is it that India is focusing on in the future to build a robust roadmap? Number one, India is trying to reduce our trade-related costs, trying to strengthen our exports. How? By signing as many free trade agreements as possible. We are in talks with countries such as UK. We have already finalized such agreements done with UAE, Australia, but other countries also are in focus. There are many other opportunities in growth. We have to expand our e-commerce export. We are trying to strengthen our role in the global supply chain. We are also trying to export items which are high value items to increase our bill, such as biotechnology, semiconductors, etc. These are commodities which are smaller in size but have a much higher monetary value. So this also is a focus area for the government. This was the 10th chapter for the economic survey. Pretty short chapter, this one. I have a couple of practice questions for you from this one once again. First, which of the following factors contributed the most to India's trade deficit in FY25? High global commodity prices, decline in service export, increase in non-oil import, or weak domestic demand? So which of them led to increase in a trade deficit? The answer is increase in non-oil import. Oil import will always remain high. The non-oil import also increased considerably. So increase in that import also widened the trade deficit. One more question. India is the world's largest exporter in which of the following service categories? Telecommunication, IT, financial consulting, travel, tourism, maritime, transport services. Pretty easy. India's strength when it comes to export especially has always been the IT services. So even if you have to guess, this should be the guess and this is the correct answer. Telecommunication and IT services is the one which has been the largest contributor to our export to the world. This was chapter number 10. We have 3 more to go. So chapter number 10 or rather 11, chapter 11 is titled Fiscal Developments, Fiscal Resilience Amidst Challenges. So what exactly is the theme of this chapter? The government of India, as you know, usually almost always spends more than what we earn. So we run into fiscal deficit. In simple terms, if the government's earning is 100 rupees, the government usually has an expenditure of 105, 110. So the remaining money usually comes in the form of deficit. The government takes loans either from the market, that is in the national market, local market, or the government takes loans from outside the country. Now, It is an endeavor of all the governments to reduce that fiscal deficit as much as possible, but due to various factors, you can't really bring it down to zero in a case like India. For example, when the COVID-19 crisis hit, the government of India had a huge shortfall of revenue, so we had to take a lot more money outside. So we are consistently trying to reduce this fiscal deficit. How do you reduce a fiscal deficit? Number one, you increase your own tax collection. You get more money from the people that owe you money. And secondly, you stop your wasteful expenditure. Wasteful expenditure can be subsidies, can be different schemes that are not required. So this is what this chapter mainly talks about. Where do we stand in terms of the money that the government owes? Not just at the central level, but at the state level as well. Where is the government spending money now? What is the way forward? So this chapter in the introduction says that in this year, the government has been trying to focus on fiscal stability and not expand its debt further. In this year, the fiscal deficit gross is estimated to be 5.9% of the GDP. Now, we do have a law about it as well. The law says, the FRBM Act says that we should bring it to 3 to 3.5% of the GDP. So, it's a long way right now, but we are going in that direction. So, let's see what are the fiscal indicators this chapter quotes one by one. First, it talks about the fact that the government is on the path of declining or reducing the fiscal deficit. The aim is that the next financial year, FY26, our fiscal deficit should reach 4.5% of the GDP, which will be a good way forward. The total expenditure this year of the government is about 45 lakh crore rupees. A lot of focus has been given on infrastructure spending, social sector schemes, and defense modernization. Now, the FRBM Act, as I was telling you, says that at the state level also, the states also should restrict their fiscal deficit to 3% of the state GDP or gross state domestic product. Now, this is where a lot of states have been struggling. In fact, if you look at a lot of states, because of this new culture of freebies, a lot of states are under humongous debt. Look at states such as Himachal Pradesh, such as Punjab. These are under humongous debt because they have taken so much money just to give it in the form of freebies or subsidies. So a lot of states are well above this 3% limit where they should be. This is the trend of how the fiscal deficit has been reduced by the government. As you can see, post-COVID, it was pretty high because the government had a shortfall of revenue. So they had to take a lot more money. But consistently, it has been on a downturn. The expectation is government is hoping that by the next financial year, we bring this number down to 4.5% of the GDP. But again, this is not going to be easy because when the government reduces fiscal deficit, it means the government has to take out or stop certain government schemes or government subsidies. People may not take it very well. On the other hand, revenue collection or being more efficient with revenue collection is another way that the government can bring down the fiscal deficit. Gross tax revenue grew by 10.7% year on year, and the direct tax collections grew by 12.4% year on year. The highest tax that is collected is in the form of the GST. GST collections also increased. Average monthly collection this financial year was 1.65 lakh crore. Now, out of all of that, the one area where we saw a decline in the tax collection was excise and custom duty. It declined slightly, but not a very sudden surge. It's just a very small gradual decline, but we made up for it in the other systems or in the other taxing forms. This is how the tax revenue has come in. As you can see in the gross tax revenue, GST makes up the most, 48%. Then in terms of direct taxes that you pay directly to the government, the corporate tax makes up the most. Then comes income tax. Now please understand and remember, there are different ways in which a question can be framed from here in the prelims exam. The question can be which of the following is the largest contributor of direct taxes in India? That would be corporate tax. Or if the question is which is the largest contributor of tax revenue in India, it would be the GST. So it depends upon what kind of a question there is. Please do remember this information as well. One key focus area is capital expenditure and fiscal priorities. As I told you earlier, the government is very adamant on increasing its capital expenditure, which is a good sign for the economy. Capital expenditure means money spent on building hard infrastructure, roads, ports, railways, airports, all these come in the category of capital expenditure. They bring in a lot more jobs. Also, they build heavy infrastructure, which is helpful for the businesses in the long run. So capital expenditure as a percentage of total expenditure has increased to 21.4%, which is a good sign. Major areas where capital expenditure has been done include road and highways, railways, power, renewable energy, urban development, etc. So these are the areas where focus has been put of capital expenditure. Again, when the government cuts down its expenditure, usually the government tries not to cut down capital expenditure, because capital expenditure brings jobs, capital expenditure has a good important connection with the business in the country as well. This is where capital expenditure has been spent this year. The highest allocation is to the railways, then road and highways, then comes in defense. Now in defense also, please understand, not all the money spent in defense is capital expenditure. So when you talk about defense, lot of money goes into pension, then salary. That is not capital expenditure. So when you're buying weapons, that is capital expenditure. The other parts are revenue expenditure. Those are not capital expenditures. At the state level also, a lot of states are trying to now bring their bring their fiscal deficit under control, but many states are outliers here as well. There has been a higher tax devolution from the center, means more money has gone from center to the states to help them in reducing their fiscal deficit, giving them a signal that you should not take a lot of loans. But freebies and this kind of a politics has had a negative impact. Many states, as you know, have also gone back to the old pension scheme. That has also had a negative impact. Now, the public debt that the government owes is at 81.6% of the GDP. It's expected it will also reduce in the coming years. The center's net market borrowing was about 11.8 lakh crore for this financial year. One big component of the revenue receipts that we have is the interest payment. So that is a big concern, because a lot of money that we earn, that just most part of it or big part of it just goes into the interest that we have to repay because the loans that we have taken. So when you take lesser loans, you have lesser interest to pay. That also is the government's endeavor to reduce the interest payments in the long run. What about the subsidies that contribute a lot to fiscal deficit? The government is trying to reduce subsidy burden increasingly. Total subsidy expenditure has reduced to 1.8% of GDP, which is, again, if you see in the last 5 years, this is a good progress. We were at 3.1% of GDP in financial year 21. We have reached 1.8% rather, almost half. So which is a good thing. Major food subsidies right now are given in food and fertilizer. With fertilizer also, the government is trying to push the farmers towards nano urea, towards having much better, much more efficient, rationalized use of fertilizer. So the government is trying to push the farmers away from heavily subsidized urea. Other social welfare schemes that get subsidy from the government include Manrega, which has an allocation of 73,000 crore this year. Then health sector spending also increased. Ayushman Bharat, as it expands, as you know, under Ayushman Bharat now, senior citizens are covered without any exception. So that also increases the government's bill of all these schemes. That also comes in the form of subsidies. This is again something that the government has to keep in mind. These are certain suggestions that the economic survey gives in chapter number 11. Financial year 26, that is next year, the aim is to bring fiscal deficit down to 4.5%. We are aiming for that. Again, it's not going to be that easy, but that is the aim. The focus areas remain having better tax compliance, having more people pay their taxes that they owe, encouraging fiscal health in the states as well, encouraging private sector also to bring in more investment. This is what the suggestion is as per the economic survey. This was chapter number 11. I have a few questions for you to test what you studied here. First, which of the following statements regarding India's fiscal deficit is correct? It is projected to increase in FY25 as compared to 24. No, projected to remain the same. Estimated to decline to 4.5% of GDP by next financial year. Yes, this is what we have been discussing. That is the estimate that by next year it should be 4.5%. Next, which component contributes the most to India's tax revenue? We just discussed this. Overall tax revenue, the biggest contributor is the GST. If it would have been direct tax, then corporate tax would have been the answer. One more, which of the following is not a factor in India's fiscal consolidation strategy? Increasing capital expenditure, reducing subsidies, expanding fiscal deficit beyond 6%. So this is opposite. When you want to ensure fiscal consolidation, you want to cut down your fiscal deficit and not take it beyond. So you have to cut it down. This is not a factor. Others are factors, others are things that the government of India has been trying to ensure. This was our chapter number 11. Chapter number 12 is titled Monetary Management and Financial Intermediation, Credit Growth with Financial Stability. In simple terms, it looks like a pretty heavy title, but in simple terms, this particular chapter talks about the status of financial sector in India, mainly about the banks. So it talks about how the NPAs, that is the non-performing assets, have changed over the years, increase or decrease, what influence the other factors have had on this, and where do we stand looking forward. What is the RBI stand? What is the RBI doing to improve the health of the financial sector? These are the things that this particular chapter number 12 talks about. So let's dive deep into what it says. So in the introduction, it gives a good news. The good news is that the gross NPAs have declined to a 12-year low of 2.6% by September 2024. Now, if you remember, just a few years ago, NPAs were a big problem and a big headache for the government of India. The RBI had been telling that many banks may go on the verge of collapse if they don't control their NPAs, especially in the public sector banks. The situation has become much better now. The other aspect of this chapter is that the financial inclusion index, that is how many people can attain financial services, the financial literacy, that also is on an increment. We have seen this number go up to 64.2 in March 2024, especially with the influx or especially with penetration in rural banking. Lot more banks being opened up in the rural areas, many people getting credit easily as compared to earlier. All this has led to a good score in the financial inclusion index as well. The first part of this chapter is about monetary policy and liquidity management. As you know, the monetary policy is handled by the Monetary Policy Committee of the RBI. They are the ones who have to target inflation. They are the ones who can change repo rate, SLR, CRR with the common intention of keeping the inflation in check in the country. These are some important decisions that RBI took throughout the year as per this chapter. RBI kept the repo rate unchanged at 6.5% for most part of the year. In December 2024, however, the CRR was reduced. Now, when CRR is reduced means the banks were allowed to have more free cash, so they could give loans easily. That led to infusion of more money in the market. So people's purchasing capacity was improved. It injected 1.16 lakh crore into the banking system as cash supply. Money supply grew by 9.3% on an year-on-year comparison. So these were some of the good things that the RBI did for our economy. What about inflation? Inflation targeting, as I said, has been 2 to 6%. This is the ideal range where we want to be. Core inflation softened. Core inflation is the inflation removing food and fuel. That softened. The commodity prices softened, although it is still increasing, but it's not as drastic as it was. Money multiplier, that also tells us about how much money is in the market, also increased, means there is more money in the market now. The banks are open, or that they are happy to give more loans as compared to earlier. Let's now talk about the banking sector performance. How did it perform in the past year or so? So first, it talks about the asset quality. As I said, the good part is that the gross NPAs reduced. They have fallen to a 12-year low. So recoveries have been better. Provisioning buffers have also been better. There are strong indicators that the banking system is becoming strengthened, and there is lesser risk of bank going bad. Capital to risk weight asset ratio also stood at 16.7%, which is much better than what the common minimum requirements are for the bank. This is a comparative table to show you how the NPAs have been declining since FY21. So as I told you earlier as well, in most of the cases in the prelims exam, rather than asking you the exact figure, the question is mostly created to ask you about the trends. So for example, the question can be, since FY21, there has been a declining trend in NPAs every single year, which is true. So as you can see, NPA, gross NPA is declining every year, which is a good sign. So these are the kind of things. Rather than trying to remember the exact number, exact data, you can just remember the pattern. Is it increasing or decreasing? What about the credit growth? Credit growth has moderated. 11.8% means how much loans are being given. As compared to last year, the growth is low, but it is still growing. Deposit growth, that is the money that people deposit in the banks, is also increasing by 11.1%. There are different types of deposits. Term deposit means money that will be given back to you after some years, like FD, fixed deposit, that you get after a few years. Savings account deposit are called as demand deposit. You can demand it from the bank at any point of time. So term deposit outpaced saving account deposits. There were more term deposits, people giving money for long term. Banks also like that because it gives them more stability to loan out this money. They know that people won't be asking for it immediately. This is how the bank credit and deposit has grown over the years. It's not a straight line in this section, credit growth. As you can see, this year's credit growth has been lower than last year, but at least it is still growing. What about financial inclusion? This is one thing that we should be proud of, we should be happy about. Rural banking penetration has increased in the country, because of which financial inclusion also has seen good numbers. Financial inclusion index, as we discussed in the intro, has improved to 64.2 by March 2024. This is a result of much higher penetration in rural areas, so many more people in the rural areas now have access to banking services. We have seen Jan Dhan accounts also being expanded. We have seen digital transactions such as UPI also increasing. All this has led to a positive number in the FII. This is again a score of financial inclusion index. Again, as you can see, it's an increasing trend. Every year it is improving. From 2021 to 22, 23, 24. It's an yearly number that comes out. So we will have the March 2025 number also very soon coming out. Rural financial institutions have played a big role in improving FII, because this inclusion has mainly come in from the rural areas. Regional rural banks, microfinance, NABARD, all of these have opened up their coffers to give out loans on easier terms to people in the rural areas, especially in agriculture. That has led to an improvement in the FII as well. What about the capital market, financial market? India's stock market had been moving for a long time. So, which is why a lot of money was attracted from within the country and from outside as well. Especially important sign is that the retail investors under the age of 30 have increased significantly. 40% new investors that entered the stock market were under the age of 30. The number of IPOs, companies going public, have also increased, giving more clarity to those investors, giving them more options, and bringing these companies under the purview of SEBI and other regulators as well. The bond market and the non-banking financial companies, they also gain prominence. The bank share in the total credit has declined from 77 to 58%. Means the 42% loans that are given out are not given by banks, they are given by non-banking financial companies and the bond market. This also is an interesting number. RBI does not prefer that. For RBI, it's much safer. They prefer most of the loans going in from the banks, scheduled commercial banks, but they can't reach everyone, so there is an alternative in the form of NBFCs provided. At the same time, there are still challenges and risks in the financial sector. We are not over and above that. First, the consumer credit in the banks have increased from 18.3 to 32.4%. Means there is much higher retail borrowing. So at the retail level, the borrowing is much more. So more money is going into retail loan takers and not the corporates. Unsecured personal loans, against which you don't give any security, credit card borrowings also have increased considerably. It's not ideal for an economy to have a lot of outstanding credit card loans and personal loans, because when you don't have any guarantee against the loan, then there's no safety of that. If you don't pay it back, the bank really can't do much. That is why it is a cause of concern. Also, on the financial market, there have been a lot of people depending upon this market to increase their money. As you have seen in the past few days also, there has been a downfall in the stock market. So it does have its own financial risk, which is also pointed out. This was our 12th and second last chapter. I have a few questions to test your knowledge here. First, which of the following measures is RBI implement to infuse liquidity in the banking system in FY25? So which of these will infuse liquidity? Repo rate increase? No, it will reduce. Reduction CRR? Yes. So reduction CRR means banks have to keep cash amount in their hand to a lesser extent. Now they can give out that money in the form of loan. That will increase liquidity in the market. Next, what was the primary factor behind RBI's decision to increase the risk weighs on unsecured loans? Because of rapid rise in unsecured lending. As we discussed, unsecured lending means credit card borrowing, personal loans that are unsecured. This is increasing, so RBI is not happy with that. One last question. Which segments saw the fastest growth in financial market participation in FY25? We discussed this. It is the retail sector under 30. This is the one that saw the most growth as compared to others. This was the second last chapter. We have one more chapter to go. The 13th chapter is titled Climate Change and Sustainable Development, Balancing Growth with Sustainability. So the topic itself tells you the focus of this particular chapter is where do we stand in terms of renewable energy, where do we stand in terms of our own commitment towards climate change, towards the environment. As you know, we are one of the few countries that are on track to achieve our own nationally determined contributions that the countries put forward in the Paris Climate Deal. India, in fact, has made our own commitments even more aggressive by improving or rather increasing our own target for ourselves without any compulsion. We have already promised the world that we will be achieving net zero by 2070, but there are many other subparts to it as well. The chapter says that India is aiming to become a Viksit Bharat, that is a developed country by 2047, and our achievements in this direction would also be dependent on our achievements in the field of environment and climate change. As of now, the economic survey clearly tells us that India's per capita carbon emissions are only 1/3 of the global average. Now, please understand, 1/3 of global average. We are not saying 1/3 of countries such as America or developed countries. Developed countries and their per capita emissions is humongous. For us, even at the world average, we are 1/3 of that. And even then, rather than giving excuses, we are committed to increasing our participation in this fight against climate change. Right now, the adaptation expenditure that we have been doing as a government have increased from 3.7 to 5.6% of the GDP between financial year 2016 to 2022. One other notable initiative by the Government of India was the LIFE initiative, which stands for Lifestyle for Environment. This was introduced by the Prime Minister in 2021. As you remember, this was aimed at pushing the people, encouraging the people to make small changes in their lifestyle so that if they can contribute even in a very small manner, even in a minimal manner to environment, they should do that. So making these changes in their lifestyle was a component of the LIFE mission. Now, the chapter first talks about climate change adaptation and mitigation efforts that the Government of India has taken. I have explained to you the difference between adaptation and mitigation earlier as well. Adaptation means now that climate change has happened, what can we do to live with it? And mitigation means what can we do to stop further climate change from happening. Now, the data here is first about India's net zero commitment. As I told you, India has committed to achieve net zero by 2070. This is not forced upon us. This is something that we have committed to ourselves. We have also committed that by 2030, our renewable energy capacity will be 500 gigawatts. Right now it is at 179 gigawatts. This is last year's number, by the way. This year number estimated is to reach 200 gigawatts. There are certain challenges with renewable energy, not just for India but around the world. The biggest challenge is the storage part of it. Solar, wind, these forms of energy are not available 24/7. So if you can make solar energy in the morning, how do you store it so that it can be used in night? The logical answer is battery, but then how can you manufacture so many batteries, because that will also require a lot of money and technology. So that still remains a major cause of concern. What about climate change issues? India right now ranks 7th amongst the most climate vulnerable countries. We have seen major cities in India running out of water or seeing flood-like situations. So these are extreme weather events that we have seen, which have cost $90 billion between 2010 and 2024. The government has been trying to fight against it by initiating efforts such as working on climate resilient crop varieties, crop that don't fall prey to these kind of issues, expanding our urban flood control system, ensuring that water management strategies are devised so that even if there is a drought like situation, we are better prepared with our reservoirs. However, fight against climate change, not just in India, around the world, requires a lot of money. So a lot of our success will depend on whether we have enough money to fight against climate change or not. This is where green finance or climate financing comes in. The economic survey says that India requires about $10 trillion for transitioning into a low carbon economy by 2070. That's a humongous amount. Climate change finance right now has been very, very low as compared to what we require. We have $30.4 billion directed towards mitigation in 2021-22. We also have the green credit program, which incentivizes the businesses to adopt sustainable practices. But again, the amount of money that is required is embarrassingly low as compared to where we need it to be. This is the actual figure as per the economic survey. Estimated need by 2070 is $10 trillion. Where we are right now, 2020-21 was about $30.4 billion. In this year, we are estimating that by the time the year ends, that is the financial year, by the time it ends, we would have raised $20 billion through green bonds. So again, very low figure. We need to do much better in terms of financing for climate change activities. Green bonds have grown, but again, the money that is required is too much to be handled just by green bonds. India's green bond market reached $20 billion in FY25. It is one of the most emerging markets in green finance around the entire world. The RBI also introduced a new concept called green deposit for banks, which has encouraged investments from those people who want to play a part and invest money into green financing. This is how our renewable energy capacity has improved. As I said, 179 was the number of last year. This year, by the time financial year ends, we are expecting that we would reach 200 gigawatts of renewable energy capacity. The aim is to reach 500 by 2030. So we don't have a lot of time left, but the government is optimistic enough and says that we should be able to achieve that. This is how the green bond market has grown. It is again improving year on year, but the rate of growth is not at a level as we would have hoped for. Then the life movement, that is lifestyle for environment movement, that the government and the Prime Minister specifically have been pretty optimistic about. This is an initiative by our Prime Minister. Again, the objective is to push people towards making small changes in their day-to-day life, like reducing waste, reducing food, being more efficient for energy, using public transport, etc. As per this initiative, 80% of Indian villages and urban areas will adopt sustainable practices by 2028. By 2030, these measures can save consumers $440 billion globally. This is not an India number, this is a global number. Also, as per this report, the economic survey says if we finish all the food on our plate, means if we avoid food waste, every single person can reduce 90 kg of food waste in a year. 90 kg food waste. So basically, if you do a rough calculation, they are saying that every single day, a person wastes usually what? Let's say, again I'm doing a rough calculation, every single day the person basically wastes about 2 to 250 grams of food. That's what they are saying. Carpooling can also save 380 million liters of fuel in the country annually. But again, see, it's a nice concept on paper, but you have to actually make policies about it. For example, there are many carpooling companies that are operational in bigger cities and they have been shut down because India does not recognize that as a law. There were protests from cab drivers saying that our livelihood will go to waste, our livelihood will be compromised if you allow carpooling. So the government has to make sure that policies are also made in this direction. Then the chapter number 13 also talks about sustainable urbanization. We know there is an increasing growth in the population in urban areas. Migration from rural to urban areas is still very prominent. For that, the government has launched multiple programs. For example, there is a National Clean Air Program launched in 2019. The objective is to reduce PM 2.5, PM10 level by 40% by 2028 and expanding green spaces in the urban areas. Also, a lot of focus has been put on recycling. The government says that by 2030, we could save 11% of our GDP by being recycling and resource efficient. For example, the LEDs that you have at your home, once they expire or once they're out of their life, what do you do with them? You can't recycle them. So government has put the responsibility on the producer. Like if it's a Philips LED, it is their responsibility under extended producer responsibility policy that they will be the one who have to recycle it and not the consumer. In the end, the way forward involves a lot of hard work, especially raising finances. We have to focus on storage technology as well and battery innovation for renewable energy. This is the way forward, and we have to make important changes in consumer behavior as well so that everyone is willing to contribute their bit. This is the last test for you for chapter number 13, this economic survey. First, what is India's target year for achieving net zero carbon emissions? Pretty simple. 2070 is the year. Again, this is not forced upon us. This is something that we have committed by ourselves. Next, what initiative aims to encourage sustainable consumer practices in India? We just discussed about this in detail. It is a life mission introduced by India in 2021 for the entire world. The last one, what percentage reduction in PM 2.5 in PM 10 levels is targeted under NCAP, National Career Program, by 2028? We just discussed 40% is the target that we are hoping for. All this information is important for your prelims examination point of view. This brings us to the end of the entire economic service summary. I hope all of you enjoyed it. You took something important from here. I really hope that this will help you in getting better marks in prelims and mains exam. If you are new here, again, do hit the subscribe button and join the Telegram channel to get PDF of all of this. You can share this with your friends as well. Thank you so much. Bye-bye.